this morning because I think it's just so pertinent to all of our businesses right now. I think I heard from a good investor recently. He's like, 30 years ago, we could just all focus on the micro. You could be a micro investor, just meaning you could just focus on Lehigh, Utah, and what happens in Lehigh, Utah, and you could make money and do well. We've now moved to a much more global economy. What happens in Washington, D.C., or in China or in Russia affects our businesses. You have to understand macro. Furthermore, if you're going to raise dollars, we're going to talk about funds today, investors want to know what your outlook is on the macroeconomic situation. Even if it maybe you don't believe it affects sub 2 and getting creative finance homes done, right? Or your software business, they still want to know, what do you think about it though? How do you think the Russia-Ukraine war affects us right now, or bombings happening in Gaza? How does that affect supply chains? How does it affect routes? What would that do for a fund that you're setting up right now in Lehigh, Utah? Does that make sense? So I think it's pertinent to understand what's going on and give a sense. So we're going to talk a little bit about tariffs, DOGE, and Fed rates that are all happening. I mean, this week and next week. We had an FOMC meeting yesterday with the Federal Reserve. So we're going to talk about all that right now. So Fed rates and market pricings. Yesterday, or what is it today, Friday, 2 days ago, Jerome Powell, Supreme Leader Jerome Powell got up and kept rates steady and plans to keep rates steady. If you guys have looked at this site before, this is the CME FedWatch tool. So can you even see that? Is that way too small? I'll explain what it is then if you probably can't see it. So what you're seeing here, over on this side, you'll see a date. This says 5/7. So this is May 7th, 2025. This is 6/18. So June. So this is the May meeting, June meeting, July meeting, September meeting of the Fed. This is what derivative traders on Wall Street are predicting or pricing in what will happen with rate moves. So a lot of people can guess, I think the Fed's going to cut rates, but what are billions of dollars betting on? They bet this thing moves every single day. So I pulled this yesterday afternoon, last night. For the May meeting, 85% probability or chance of no change again in May. We had no change just barely, and again, no change. June, 62% chance of a change. By July, 48% chance of a change by 25 basis points. So really not much. The market has really not priced in much movement. This chart 6 months ago was pricing in significant rate cuts in 2025. It is now adjusted for really rates to be higher for longer, which is Jerome Powell kind of talked about. They're going to wait and see kind of a thing. Now, these change every day though. Depending on new data, new stuff, this can change overnight. But that's currently what the market is pricing in, at least as of last night. Furthermore, this is, man, you guys probably can't see this at all. So this is the Fed's projections for rates. I'll just explain this chart, but it's essentially saying the same thing of last year, they were predicting more cuts this year. And now they're not going to do those cuts. Now, why is that significant for us? This affects every part of our market, right? The Fed funds rate, how much you can borrow and lend money at is huge. You've seen mortgage rates for real estate have actually gone up, but they cut rates in September. Did you see that? It actually went up. Mortgages went up, and you're like, why would mortgages go up? This is, we've seen, at least feels like, pretty expensive money right now in the market to get a mortgage. I got a mortgage on a house last year. We moved to our new home. I got a 7.6% interest rate. I think I bought the peak of interest rates, which I'm okay with. I'm like, I'll buy the peak rate because that means there's not as many buyers. So the price will come down, right? I was like, you can date the rate. You can't date your purchase price. So, but I'm like, the rate hasn't moved much since that. I bought it in June, right? We'll see how, where things come here over the next little bit. Now, this is, hopefully you can read this. Trump tweeted this yesterday. The Fed would be much better off cutting rates as U.S. tariffs start to transition and ease their way into the economy. Do the right thing. April 2nd is Liberation Day in America. Anybody know what's happening April 2nd? You guys follow on this? April 2nd is Liberation Day in America. What is he talking about here? Tariffs. Okay? Anybody watch the State of the Union address? There's been a lot of tease on tariffs. There was tariffs on, tariffs off, right, with Mexico and Canada. April 2nd, Trump is looking to put in tariffs on everyone who puts a tariff on us. They're called reciprocal tariffs. Now, let's see. I'm going to pause on this. I'll come over here. So previous average, I did some research. I did a full research study yesterday on this, on tariffs. So previous average tariff for the U.S., just in general, is 1.5%, which is pretty small right now. If they do all these reciprocal tariffs, it'll move to about 4.8%. So about a 3.5x increase. Reciprocal tariffs on other countries who tariff us. That's the plan. So on April 2nd, anyone who puts a tariff on us is going to get the same exact tariff back on them. Okay, so what are those tariffs? And furthermore, Canada and Mexico tariffs are going to go into effect on April 2nd, and they're reciprocal tariffs, and it's with the border. So they've got to help secure the border. That's the other caveat of the Trump plan. Now, we don't really know, though. This is all what the Trump administration is putting out, but we're going to see April 2nd what really happens. But this is what they've told us so far. You guys following along? Is this making sense? So April 2nd is, back to this, Liberation Day in America, because his plan is to reprice a lot of these trade agreements. So now some people are like, well, why is Trump being so mean, right? What are these tariffs? He always says we're getting ripped off by other countries. What does he mean? So let me give you a few examples here. This is India to the U.S. right now. India charges a 50% tariff on motorcycles, like Harley Davidson motorcycles. 50%. 150% on whiskey and alcohol. So all of our, Budweiser, all those American-made alcohol products, 150% tariff. They've done this for years. 20 to 70% on almonds and apples. There's a lot more. I just picked a few here. Europe to the U.S., 10% on automobiles. We only charge 2.5. So if you import a Volkswagen or BMW, 2.5% tariff. If we send them a Ford, 10% tariff. 5 times bigger than our tariffs on them. 25% on whiskey, 25% on jeans, like Levi jeans, 25% on cranberries and orange juice. Okay, this is what Europe is currently charging us, and they've done this for years. I think a lot of people don't, I mean, even myself, I didn't realize this till Trump pointed this out. I'm like, oh, I didn't realize this is happening. Let's go to China to U.S., 25% on soybeans, 72% on pork products. So if you're a pork manufacturer in here and you're trying to export, we have a friend of ours, he does this. 72% tariff China currently charges on our pork people in the United States. 25% on automobiles. You rarely will see a U.S.-made automobile in China because of the high tariffs put on by China, and they have their own manufacturers, and we do the same thing though. We don't like having their BYD cars in the United States. 25% on liquefied natural gas and 25% on coal. So the plan is April 2nd, we will do a counter tariff, 25% on their coal. 72% on their pork. How do you guys like it? You're tariffing us, we'll just tariff you right back. A lot of people are like, well, what about Canada? Canada's our partner. My mom is Canadian. I have all my families in Canada. I love Canada. I did not know this till last week. They charge us 270% on dairy products. 270%. They've done this for years. 25% on U.S. steel and aluminum, and 10 to 25% on prepared foods, chocolate, things like that. Tariffs they put on us. Mexico charges us 10 to 25% on agricultural goods. You see industrial goods. Turkey, I put another one on here, 120% on automobiles. Okay, so this gives you a sense of reciprocal tariffs that are going to hit next week. What is this? A week from Tuesday. This is what's going to happen. Now, there's been a lot of rhetoric, right? You've probably seen some of that in the news of countries. This is bullying or whatever. I believe the current plan that he's put out is saying, whatever you do to us, we're going to do back to you. And it's looking like a negotiation tactic to say, hey, if you lower Canada, drop your dairy tariff and we'll drop ours. We're going to put ours up at 270, just like you are. And if you drop yours, we'll just drop ours. And so that we can have free trade across countries. Does that make sense? So, we'll see how this happens. This is going to shake the world, I think, on April 2nd first. Now, what we've seen so far, the Mexico tariff and Canada tariff that went into effect, remember this? And Justin Trudeau was all hard. And then they backed down in about 12 hours or less. Mexico backed down in about 18 hours or less because of the effects of tariffs. And Canada, one of the province leaders came back and said, we're going to put another tariff on you guys. And Trump just tripled. Fine, we'll just triple the tariff. 2% of our economy depends on Canada. 20% of their economy depends on the United States. So yeah, we can play this game all day long. You want to play this, Canada? And they dropped their threat within hours, right? It's really interesting to watch right now. Geopolitical events happening. Like, we've never seen this before, by the way, which is it's kind of crazy. Now we can go complain on Twitter. We can be mad or whatever. Honestly, there's nothing Bridger Pennington can really do about this. So how can I make money? That's where my brain goes. Well, how can I make money off this? How can I do well off this? I don't know if anybody else have that same thought. I guess you can go vandalize stuff and be crazy, but like, okay, the world's shifting. How do I prosper, right? Like, the wealth gap is dividing. I know there's a lot of stuff we can try to help out, but like, how do I end up on the wealthy side? If it's going to divide anyways, I might as well end on the wealthy side, right? Now, all that being said, if we want, there's stuff we can do, there's things we can do to help people. And one of the reasons we're here today doing this, we have a mission at Fund Launch to democratize Wall Street. We want to make this kind of stuff known to regular people, like myself included, people in Utah. We're not in Wall Street. We're not in some Ivy League tower. We're in Lehi, Utah right now. Can we learn kind of some of this stuff that's like high finance on Wall Street, right? So is this interesting, by the way? Is this useful? Kind of cool? Okay. A few other things that are happening right now. Obviously, you guys have seen the DOGE cuts. Been a lot of rhetoric around this. This is kind of and you probably can't read these charts below, but the currently our GDP deficit to GDP ratio has skyrocketed during the Biden years. So, or let's just call it COVID. Since COVID, we were historically at around 2 to maybe 3% deficit to GDP ratio. That has jumped to around 8%. This is I just listened to an interview with the brand new Treasury Secretary, with all the people at DOGE, the new people, they all are talking about this. Let's see if I have a picture here. Ray Dalio right here he's put out a whole new book, and he's like, we have to get this down now. The United States government is on life alert, and we have a hope if DOGE can cut enough and we can increase. It's like, think of it just like a business. If we can cut enough spending and get enough revenue in, we could get this 2% back to this 2% deficit to GDP ratio. We maybe will save our country. We are in the what they call a death spiral. If you look at private equity world, the number one thing that kills companies in private equity is what they call a debt spiral, where you have to borrow more debt to pay off old debt, which is kind of what we're doing right now, right? And I'll go back a little bit. During the Biden administration, they issued $6.4 trillion all in short-term treasuries. And it was this marvel. I was like, why are they doing this? Why is Janet Yellen right here? Why are they doing all in short-term? Why don't we do some medium-term, some long-term debt? And a lot of this was done at really low rates. All those are going to be refinanced this year at the current market rate, which will be, right now it's 4.5%, but it's, there's usually a little premium on that. We have to refinance $6.4 trillion of treasuries this next 8 months. The Trump administration has a huge problem on their hand. We'll see if they can solve this. So if you look at the Trump plan, you've probably seen all the DOGE cuts with USAID and other stuff. Can they cut enough spending, and can we increase enough revenue? They need to cut on, it's looking, but depending on who you talk to, between $800 billion and $2 trillion of annual budget to get back to a 2% deficit, okay? Again, Ray Dalio put out his new book. He's like, we are on life alert right now. We have to do this now. It can't be done next year or the year after that. I was with Tony Robbins 2 weeks ago in a group about this size. Kind of interesting. So Tony shows up. We got all a chance. You guys follow Tony Robbins, know his stuff. So it was very interesting. We were in this small group. Dean Graciosi's there. Pace Morby's there. A bunch of other very cool figures are there. We're in just a small group. We're talking to Tony. And he gets up just like this on a microphone. He's not doing the big rah-rah thing. He's just talking to us like normal humans. He's like, I was just with Milken, the Bond King, from the 80s. I was with Ray Dalio and about 7 to 10 other billionaires that are all in the financial space. He goes, they shared with me they believe there is a decent chance the U.S. will have to default on its debt or restructure its debt. So if you own a bond and they say, well, that bond was supposed to pay you 4.25%, we got to, it's actually going to pay you 3.25%. Which would be, that would really change the sovereignty of the United States. He goes, there is a decent chance in the next 18 to 36 months the U.S. will have to do that because of all the short-term debt that Janet Yellen put on our economy in this last couple of years. The only way out, and Ray Dalio has been on a full speaking tour the last 2 months, roughly, talking about how crucial it is to get down to a 2% deficit to GDP ratio, and there's a chance we're okay. So anyways, this is kind of interesting. I saw this quote on Twitter that I loved. I thought it was funny. Only Trump could make liberals hate electric cars, which I thought was pretty funny. I don't care what side of the aisle you're on, but that's funny, dude. That's funny. I don't care who you are, bro. Okay. We've seen a lot of hate on Tesla and DOGE. Now, and I'll say this, they're not going to do everything perfect, but if they can do 80% of it, well, when you cut a lot, you're not going to hit everything perfect, but can you cut enough to get to this pretty soon? I'm all in support of cutting, government spending. Now, do it in the right way, do it the right fashion. But are they going to make mistakes? Sure. But when you're doing that drastic of cuts, you're going to make mistakes, and maybe they can rebuild back from a zero-based budgeting thing. Okay, last thing I'm going to share here. So if I was to summarize the Trump plan, Now, whether you like Trump or not, this is the plan that we're in. And I'll just say this. When Biden was in office, I was rooting for Biden, dude. I was like, I live in this country. I want Biden to succeed. I'm like, I'm in. Like, I didn't vote for Biden. You guys can probably tell that from just me. But I'm like, Biden got in. I'm like, dude, I'm rooting for the guy. I hope he crushes it. I hope he does well. I live in America. I want this place to be awesome. Trump's in office. I'm going to root for Trump. Okay, until next election cycle, like what can I do about it? You know, I'm going to root for the guy and try to help, see what happens. So this is the plan, at least, that they've put out. So over here, you can see cut spending to get to a 2% deficit GDP ratio. So cut. Increase government revenue. Tariffs from the Internal Revenue Service. We'll see how that works, or just lowering other countries' tariffs. Increased minerals and oil production, they put a huge emphasis on that. And then they mentioned a gold card for immigrants, $5 million gold card that immigrants can buy. So increasing government revenue. Okay, so cutting, increasing, and then lowering rates. Trump's trying to really lower rates to stimulate the economic activity. Lower rates to refinance the $6.4 trillion of short-term debt to be refinanced this year. Our debt payments right now are greater than our military spending. Right, our interest payments this next year will be, I think, 1.2, 1.3 trillion. Am I rough on that math? Is that about right? Our defense budget's about 980 billion. Now, these are big numbers. To put that into perspective, we spend more on our military every year than the next 10 countries combined. That's how much we spend on our military every year. And our interest payments are that much higher. So that's the plan. And then finally, increase productivity, crypto and AI capital of the world. I run a crypto fund. We love that. We want to make a lot of innovation happen in the United States. And then finally, encourage foreign investment in the United States, which we've already seen a lot of that. Saudi Arabia, Middle East, China, a lot of different groups putting huge foreign investment in the United States. So we'll see. And he wants this to be the golden age of America. I'm rooting for him. I would love to be in the golden age of America. Wouldn't you? Like, let's see if it works, the economic data that I'm studying, I'm like, man, this seems like it could be a rocky path in the short term, but I think will be a decent to amazing path in the medium to long term. So we'll see how this works. All right. Was that useful at all? Okay. Is that helpful? Sound good? Okay. Now, how does this apply to us? Like, what does this mean to me and you? So let's talk about that. And then I want to share from you guys and hear from y'all. So let's talk about emerging fund managers. As you guys know, I run 2 investment funds. We manage roughly, I think, combined about 50 million AUM, something like that right now. We just closed Fund Launch Partners. We raised a $30 million fund. We oversubscribed at 33 million, which was pretty exciting. We just did that last week, which was pretty awesome. What does this mean for us? Like, why are we even doing this meeting today? Like, what does this make sense? Emerging fund managers, you probably can't see this, but this chart shows, in a lot of cases, outperform larger funds. Statistically, like by performance metrics, smaller funds, this is excess returns, additional return above private equity, real estate, venture capital. Because, and the meaning for this is, a lot of times emerging fund managers can find niches that are inefficient and small that have alpha to be grabbed. This study's done over $1 billion. So once funds hit over $1 billion, it's much harder to get a return when you're managing like $3.5 billion. It's much harder to get a 20% return managing $3 billion than get a 20% return when you're managing $200,000. Does that make sense? Like, just because the dollar amounts are so much bigger. We have a really interesting opportunity as emerging fund managers, micro fund managers in the space to capitalize on what's going on in the market right now. Now, as well, some of you guys have heard me talk about this before, but 3 funds are currently taking over the world. Vanguard, State Street, and BlackRock. Combined, these groups manage roughly $22 trillion of assets. 22 trillion, which is just bonkers. I'll share a few things here. They are the top shareholders, and I believe 492 of the Fortune 500 companies. They are the top 2 shareholders. And they just bought the Panama Canal. BlackRock did. Yeah. I mean, if you're wondering, who runs the world? These people run the world. Okay, Larry Fink at BlackRock runs the world. And Lincoln was just with him actually last week at an event, a small kind of private event. It was pretty interesting. Now, how they do this, they run a lot of times ETFs or funds that investors or people put money into, and then they go buy Apple stock or whatever. But they hold the voting rights. What's the job of a CEO, a Fortune 500 CEO? What's the job? Return shareholder value, right? Or increase shareholder value. So if you're the CEO of Apple Computer, you're Tim Cook, and your biggest shareholder comes to you, BlackRock, and says, hey, Tim Cook, we love what you're doing, but we need for you to push an ESG initiative. Or else we're going to divest you and sell your stock. and that'll cause your stock to plummet, and we're going to pull out of your stock. Well, if you're Tim Cook, what do? You follow what your biggest shareholder tells you. This happened about a decade ago. All these companies signed up for ESG initiatives, like all at once. Did anybody realize? Like, it was like, how did they get all of the Fortune 500 companies, like overnight, Walmart, everybody, to do ESG? Now, whether you like ESG or not, I don't care about that. But it's just like, how did they do that? Oh, it's because BlackRock mandated it. They said, you cannot be in our portfolio unless you have an ESG initiative in your company. So all these companies come out with it, which is an environmental, social, and government. So they had environmental things or social things or governance things that they were going to go like do good in the world things, which is some of them turned out good. BlackRock has now backed away from that in about 2019. They said this actually turned out horribly. It didn't go as intended. We were trying to do these good initiatives, and it turned out they turned into all these strange, weird initiatives that people were like moving money around in weird ways and just didn't work out. So they took that away. But isn't that interesting? That one company can control the Fortune 500. Another way to look at this, some of you guys aren't in the equity markets. Look at real estate. Right here, 1 in 7 homes in 2021 was purchased by Wall Street. 1 in 7. 2022, 1 in 5 homes were purchased in Wall Street. 2023, I have not found the data. I don't know if they didn't publish it, but the estimates are it's 1 in 3 homes were purchased by Wall Street in 2023. 1 in 3 residential homes bought up by big firms on Wall Street. Isn't that interesting? The actual... Not the mortgages. No, mortgages are owned by whoever. That's been done for years. They're actually coming and bidding on homes. If you wonder where are all these cash buyers coming from? They are big firms watching. They're buying hundreds of thousands of single-family homes. Farmland as well. Bill Gates, one of the biggest farmland owners. A bunch of big firms coming buying farmland. It's very interesting. These big conglomerates are buying up these ecosystems. I'm going to go faster for a second, but you're seeing consolidation of all these TV, news, food production, accounting, car washes. And you're seeing new places starting to get consolidated right now. Car washes, Amazon sellers, dentists, social media accounts. We have a group in Black Card right now. They're buying up as many social media accounts as they can buy. You don't tell the difference, but it's owned by one group. And they have, I don't know, let's call it 20 different social media accounts that all post whatever they want them to post. Very interesting. Bloomberg did this. What's his name? Michael Bloomberg. Remember when he ran for president? He was paying tens of millions of dollars to buy up meme accounts on social media to push memes that would kind of promote his campaign. Very interesting strategy. You know, whether it's good or bad, just be aware of what's going on in the world right now. There's a video here. I don't think Can you guys hear that?
News has become all too common on social media. More alarming, some media outlets publish these same fake stories without checking facts first.
The sharing of biased and
false news has become all too common on social media.
More alarming, some media outlets without checking facts first.
Unfortunately, some members of the media use their platforms to push their own personal bias and agenda to control exactly what people think. And this is extremely dangerous to our democracy.
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 Isn't that freaky? Anybody seen that before? That came out a few years ago. It's all I've seen it 100 and it's always freaky every time I see it. I'm like, man. But this happens because of the media conglomerates of who owns the media. It's about 4 companies that own all media that me and you watch. And here they are. If you zoom in on that, you'll see all the brands of every single TV show and everything you see underneath there. Most of the world is being consolidated. Here's another one. Disney actually bought 21st Century Fox, so there's the 5 media giants right there you can kind of see. I'll go fast through this. This is food production. These are the few brands that pretty much control every piece of food that me and you eat and drink. Furthermore, I think it's phenomenal what RFK hopefully will do. We'll see. I love the plan. Let's make America healthy again. I'm rooting for him. You know, like, let's go. That's like one of the most things I'm excited about. Like, let's get out freaking red 40 dye out of our stuff. I go to Canada or Europe and the food is way different. And you feel good. It's very interesting. Here's 14 car companies that own pretty much every car brand. I'll go quick through this. But you see FCA owns Fiat, Chrysler, Jeep, Ram, Maserati. All the same company owns all those cars. Down below, the Volkswagen Group owns Audi, Skoda, Bugatti, Bentley, Porsche, Volkswagen. All the same company. So if you're like, screw my Volkswagen, I'm going to go buy a BMW or an Audi or a Bentley. It's all the same company. You know, they're all the same parts. So how do we play in this game? Like, what do we do about this? We have seen this major rise of what they call the retail investors over the last few years. So if you go down 2010, about 11% of equity markets were retail investors. Like that's regular Joe kind of investors. In 2023, it's 25% of equity markets. We've actually started to increase a lot of our shareholder of these actual equity markets and moved quite a bit of them. So we call ourselves the Wall Street Rebels in this community in Fund Launch. Some of you guys are here, have been in this before. We call ourselves the Wall Street Rebels for this thing because we have actually seen small funds start to move the market in very significant ways. And Wall Street's had to pay attention now to what retail investors are actually doing in the markets. We've moved things quite a bit. So I'm gonna jump through this again. There's a couple major opportunities right now. Dry powder is at its highest levels. This is undeployed capital from private equity firms. So this is showing $13.1 trillion of big private equity firms. This is their dry powder, meaning money they haven't deployed yet. So if you raise, like we just raised $30 million for Fund Launch Partners. We haven't deployed it though. We've only deployed, I think, $3 million. So we would have $27 million of dry powder, undeployed capital that we need to deploy. Does that make sense? This has hit like all-time highs. It keeps hitting all-time because private equity firms are looking for people like us to build great companies or conglomerate really cool companies that we can go sell to bigger groups, or we can just keep growing ourselves. But there's a lot of capital waiting for good deals. Is kind of what I'm trying to show here. Furthermore, baby boomer wealth transfer. We're seeing right now the silent generation, which is older than the baby boomers, which you never hear about because they're silent. Oh, okay, there's my joke for the day. The boomers plan to pass down $84 trillion through 2045. Just a stupid amount of wealth plans to be, some of it's direct to heir, some of it wants to be divested or sold to businesses. Anybody bought a baby boomer business or seen this model of baby boomer business? A lot of people right now are looking to buy, mom and pop accounting firm down that the guy's old and they just want to get out of it. And you can do creative finance and you can actually buy them for $0 down. You just say, hey, we'll run and operate the business for you. We'll do profit sharing with you over the next 24 months. We'll pay you out your retirement, but give me ownership of the business. Great. I have some younger person come run this business for me. Awesome. Okay. We're seeing huge wealth pass downs from the baby boomer generation down to these younger generations. So, you guys feeling good? Is that okay? Okay. I want to share some of that. Now we're going to dive into kind of funds, and then I want to talk about your business as well and what you guys are doing, and we can just whiteboard stuff out and have some fun. Does that sound good? Okay, real quick, if some of you guys don't know who I am, or I don't know why am I up here, like why do I have the microphone? It's probably a bad idea to give me the microphone, but anyways, I have the microphone, so I'm talking. But just real quick on me, just my background. I've ran 2 funds through Blackbridge Holdings. I'll share that story in a minute. We run Fund Launch as well. We have 100,000 students in Fund Launch now, which is just bonkers. We've done multiple 1,000-person events, and then I run Ugly Unicorn and Fund Launch Partners, 2 investment funds right now. Ugly Unicorn's roughly a $25 million equity hedge fund in crypto right now. Crypto's been all over the place. We can talk about crypto if you guys want. It's been very interesting to be a part of it. It's been an awesome fun to be in though. It's been really, really great. Fund Launch Partners, we just closed our final round, raised I just mentioned $30 million on that, and we're doing GP stakes. So we're actually investing into our members' funds that come out of Fund Launch. So we help people launch funds. And the best funds, we looked at 900 funds last year, and we invested into 6. So we have a huge pool of funds coming through Fund Launch that we put together, and we'll invest in the best ones. We partner with them and sit on their board and their team and help them grow. So we did 6 last year. We're looking to do 10 more this year. Does that make sense? Cool. So, and then there's me and Mason. We're co-founders of Fund Launch. We've got, decent following and stuff. Mason's in the back here. You can wave, Mason. Say hi. There he is. And then this is my family. It's my wife and our son, Jonah. We just had a baby, 6 weeks ago? So, kind of fun. I was up through the night, just barely. You can probably see it. I got a Celsius here. We'll see if I have to crack it open in a minute. We had a crying baby last night, but it's fun. So that's Jonah. I don't have the picture of the baby on here. We don't have an updated family photo, but that's us. So, okay, let's do this for a second. Let's see. Well, let's just do this. Yeah, I'm going to jump over. So, House event today, what I want to do, this is our first time ever doing something like this, like a workshop style, just come hang out. I want to spend most of it, that was my spiel, just barely. Most of this I want to share about your funds, what's going on in your business and your stuff right now. Does that sound good? And we just whiteboard stuff out. We can answer questions. We can talk about what's working or not working in your business. Sound good? Okay. Okay, let's do this. Pull up. Do you have something to write with? Anybody have something to write with? Okay, answer this question for me, and then I'm going to switch over here. all of you came here today. You spent some time out of your day. Which I really respect that you guys came here and wanted to do something together. Write down what is the number one problem. We're going to talk about financial things, I guess, right now. Number one problem in my business. What is the number? And you can maybe make 3 problems, but try to get down to 1. Write, if you can, write or get out a phone. Take a note. We'll do a few notes here, but if you can participate with me, thanks to you guys for leaning in. What's the number one thing, I came here this morning, I'm looking to solve, right? What's a big problem in my business right now? Maybe it's keeping you up at night. Maybe it's bugging you. If we could solve this one thing, it would really unlock, and be more detailed, the better. Okay, so I'll give you 30 seconds here. They say half of solving a problem is just identifying it clearly. So do that for me. Number one problem in business right now. What's going on? And then maybe check. I don't know why it's not working. Maybe come help me, Kendall. Number one problem in business. Now let's do this. Below that, let's write down current ways that you've tried to solve this problem. So keep going. What are the current ways that you've tried to solve this problem? And maybe you haven't tried to solve it yet, but what are some ideas? Write down some ideas on how you could solve this. And thank you guys for participating with me. Number one problem in your business, and then how have you currently tried to solve or tackle this problem? All right, you guys got something? Yeah? Give me some nods if you got something written down. If not, if you're still going, just keep going. But give me a nod. So one more time. Give me a nod if you're ready. Okay, I'll give you guys 30 more seconds if you people are still going. Don't check your bracket or Twitter, okay? Don't be texting people back. Try to be here with me if you can. All right, let's do this. Okay, you got something written down? Stand up for me. Just stand up, get some, shake it out a little bit. Stand up, everyone stand up, stand up, stand up. Stand up, shake it up a little bit, kind of move your shoulders a little bit. Everyone stand up. Most of you, I'm guessing, came, well, actually, we'll just stay together for a second. If you came with somebody, maybe go find someone different around you, but get into groups of 3 if you can. Get into groups of 3, and you're like, frick, Bridger's going to make me talk to people? Yes, I am, okay? So, introverts, I'm sorry. You got to meet some new people. Say hello, find a group of 3, get to know their name. Make sure it's a group of 3, not a group of 2. Get a group of 3. Grab somebody. If you're an extrovert, grab some people. Let them join. It's okay if you're a group of 4, but grab a group. Okay. Yep, make a group of 3. Let's see, you guys get over here. All right, what you're going to do is share what you wrote down. Hold on. Come back real quick. Sorry, I should explain before you got going. You got your groups of 3? My bad. We're going, though. We're good. We're still live. Okay, you got your group of 3? Perfect. We're going to do, let's say whoever's got the most facial hair goes first, okay? Most facial hair goes first, all right? So if you shaved, you're in good luck. I want you to share, hopefully you're comfortable, you're here to learn, you're here to get some stuff down. Share what your biggest problem in your business is. Hold on. Shh. Okay, you're going to go first. You're going to share what your bigger problem is in your business. You're going to share quickly how you've solved it. The idea, though, is not for you to talk, okay? The idea is for you to quickly share what your biggest problem is, how you've tried to solve it, and then let the other 2 people think tank your problem for a second, okay? So we're going to give each person about 4 minutes, 5 minutes per, let's call it 5 minutes. I'll put a little timer up there. 5 minutes per person. So if I went first, I would say, hey, my name is Bridger. My biggest problem in my business is X. I've tried to solve it with A, B, and C. I need your guys' help. Let's spend the next 4 minutes and 30 seconds answering that question. The other two people can think tank your problem for you. And then once you're done with that person, you rotate and the next person goes. Sound good? Okay. Ready? 3, 2, 1, go. Longest facial hair goes first. Thirty seconds and then rotate. 30 seconds, then rotate. Okay, switch. Go to person two. Person two, switch. Keep going. Sorry, the music's glitching out. Keep going. Keep going. 2 more minutes. Thirty seconds. 30 seconds. Start wrapping up. 30 seconds. All right, come on back. Start wrapping up. Come on back. Come on back. Find your seats. Come on back. Come on back. All right, come on back. Find a seat. Find a seat. All right, y'all. Pretty fun. Anybody meet somebody cool? Yeah. Come on back, y'all. Come on back. Anybody want to share someone, maybe an insight you got, or someone cool that you met that you want to highlight them? I'm just gonna open-ended. Anybody want to share? Yeah, Ethan, stand up for us. Let's see. I think we'll have here, but yeah. Which one do you want to share?
Actually, first, this is the first time that useful responses has ever happened in this type of event, and
Clap it up for that. That's pretty sweet.
That's
pretty good. Who was your partner?
Eric, and right as you asked,
Eric and Jake.
Okay, thank you.
Pretty good responses then. So well done, Eric and Jake. Okay.
And
Yeah, Eric was he was pulling all the weight. Yeah.
well, the thing I appreciate the most about their responses is you can tell from where they come, their principles and the ethics that they bring to it. And everybody I've met and known who's associated with Fund Lunch has those. That's who you attract. It's you could have the sharks, and in this case it's a negative mindset. You could have the vulture mindset. They make money. That's fine, but you want to be able to look at yourself at the end of the day. And I know these two guys have that goal in mind as well.
What did they share with you? What was useful? They shared. There was one in business. What did they share with you? What was useful?
My question was systems, and they went first to the trust place of I'm trying to integrate the new acquisitions, and the efficiencies we bring are.
Sorry, I'll put this on here. Systems into new businesses that you're acquiring. How to implement those? Is it more CRM, like all tech stack? Like, give us more detail on your question.
So the question comes from the base level efficiency that we bring to the acquisitions we have are those, yes, mundane tasks that every business shares. That is a high cost for small business. If you have those shared ecosystems, the cost comes drastically down, but also your consistency and your predictability go up.
So what did they share with you?
And so going first to trust with the individual employees at the new businesses, investing in those individual meetings and those like looking people directly in the eyes of this is what I'm here and here for. And what I got from it is basically the heart on heart of this is my motivation to join with theirs.
Interesting. So to summarize, making that really clear to the acquisition company. Correct. Where your heart is at and what you bring to the table with them and how you're going to affect their business and help them grow from a more heart-on-heart approach, like you said. Very cool. Correct. I love it. Clap it up for Ethan, everybody. Well done. Let's go over to this side. Anybody want to share something that you got out of this, or maybe highlight just someone cool you met in your group? Anybody want to share? Yeah, go ahead. Maybe have you just this mic short. Let's see. Just because we have people on Zoom or whatever, see if we're trying some new stuff out here. Oh yeah, that'll work. Yeah. Tell us your name and stuff and what you're doing real quick, and then tell us what you got out.
Okay, so my name's Shidler Bennett. I have been doing franchises and debt for the last couple of years, and we built a crumble portfolio and then have looked at new opportunities and have had people say, we want to give you money, and I don't have any structure in place to accept the money. And to me, every time someone says, man, I'd love some exposure to franchising, and I don't have something to offer them, I just feel like I am just wasting opportunity. I'm not building a list. I'm not doing anything with that. So Isaac made a great comment where I've really thought about this because I just set it up as a partnership as I was raising money for my stores, and it's flipping it from looking for partners as instead looking for investors and giving them an opportunity to invest in and not to come be a partner, and just changing my mindset on that, which was really helpful for me.
Yeah, I love that. Well done. What was your name again? Isaac. Isaac gave you that kind of thought.
Yeah.
Very cool. Shiler?
Shidler.
Shidler?
Yeah.
Not like Shiler. Anybody else have any back and
Just really quick, quite a coincidence because I'm building a holographic communications, holographic telecom company. One of the problems I've had is the only... Yes. Yeah. So a little bit more. So yes, it is. It is. And so the problem I've had is that the only device that we could make it work on was a Chinese company, $380 glasses. But just had a lot. Yeah, it connects to your phone. So we could have this right now. You could have people at this event, instead of having to fly here, they could just come here virtually, right, and still network. So anyway, this guy here who I met, one of the first people I met here today, happens to have a solution that I can explore to make the glasses here in the country, which is the exact next step that I need to take. So that was a pretty cool. Yeah.
What was your name? Nate. Sorry. Nate and Fabian, and you sat next to him. That's amazing. I love that. Clap it up. Well done. That's sweet. I have a connection for you too. One of our portfolio companies is Minovo. They invest into Sign Glasses. You've heard of them before? Sign Glasses. They made a heads-up display. They have patents out of BYU. They've now blown up. It's all for people that are deaf. So it's an automated like AI sign language that pops up on their glasses. So when they're in class, they can watch the teacher, because they used to have to like look to see the signer, and then they'd miss the slides from the teacher. So it just auto translates it right on the screen, so they can see someone doing sign language for them. It's pretty cool. So they have that technology, and they develop in the U.S. So we can connect you with them. They're in Utah right here. They actually know the hardware. They have all the hardware done. Yep, they do all of it. Yeah, we can connect you to them. Very cool. Well, thank you guys for participating. Hopefully that was somewhat useful. Meet some people in this group. All right, let's do this for a sec. You guys still good? Energy okay? Feeling all right? You guys want to keep going? We can go a couple different directions here. I'll let the group decide. I've got a ton of content. I mean, we can just talk for days. I've got hundreds of hours of content we can talk about. I want to see what's most useful for this group. So we can just go over what funds are, how funds are built, like fund structuring. I know some of you guys are looking to raise capital. You mentioned like the Crumble franchisee stores over here, Shidler, right? Mentioned like you wanted to build that. We can go through syndications and funds if we want. We could do some of that. We could talk more capital raising, at least my frameworks around capital raising. We can talk around how to analyze and underwrite deals. What would be useful? We got a small group, yeah. So capital raising, over the hump of 5 to 10 million. Very cool. We just did a full capital raise right now for Fund Launch Partners. So yes, let's talk about that. I love it. Let's put it on the screen here. So we'll definitely hit capital raising. What else? Just shout it out. What else would be useful for your what's going on right now with you? Underwriting deals, analyzing deals. Okay, very cool. So would you invest in those deals? And sorry, are they your deals or are they somebody else's deals? Ah, cool. Okay. So how would you underwrite due diligence, DD, that's what that stands for, due diligence on their deals, and how would you underwrite them? I love that. We do that all the time with launch partners. We looked at, again, 900 deals last year to do 6. So we have a full process we can walk through that. I love that. What else would be useful? Yeah. So team, how to structure a team, how to incentivize teams, all that kind of stuff. Very cool. I love that. Yeah.
Now that we're raising some of these big funds, like a $270 million fund, it's difficult right now. We need our company, our GP. So we're raising $10 million in the actual company.
Mm-hmm.
And when you have these big funds, it's difficult to bridge that gap. Like, why would you need my little 100,000, 500,000, million when you have all this big money coming in?
Okay, so small investors and big investors at the same time. So I'll write down small plus big investors, right, in one fund. Is that a good way to say that? Sure. Okay. My I know I have really good handwriting, so you don't have to compliment me. I know. I know. Any more? I saw a few other hands. Anybody else? Yeah. Ooh, I love it. Licenses. Yep. What license do I need to do this? Raise capital. How do I do it the right way? How do I not go to jail? How do I make sure investors are happy? This is huge. You know, we're going kind of through a market cycle. We've seen a number of people in this area, right, that have been fraudsters or come out bad. And like, what's interesting about that too is a lot of them. It's funny. I know a lot of the people that have been in this area that have turned out to. Well, we'll just see how it all plays out. But you look at their funds 3 or 4 years, 5 years ago, they're raising for, and like me and Dan. I'm on a tangent here. Me and Dan I'll tell you a quick story. We had one of our biggest investors in our fund. He's like, Bridger, how did you guys? Because we got pitched all those same deals and they all wanted to partner with us. And we said no to, he's like, you guys, he goes, I invested in, I think 11 deals, about $1 million each over the last, whatever, let's call it 4 years. He goes, ugly unicorn, your fund is the only one that's turned out good. The other 10, so 11 total, 10 have turned out to be bad deals or fraudsters. And then he said, how did you guys avoid those? You and Dan, my partner Dan Young, you guys didn't partner or invest in any of those. How did you guys do that? And I was like, oh, it's not that hard. Like, because if you read the paper, like if you read the fund docs, you could tell like this is not going to work, you know, but no one reads the docs. No one actually does the due diligence on the deals. We can talk about both of these. And I was like, oh, super obvious. Like, I'll just tell you too, they don't do third-party audits. They don't audit their fund every year. I'm out. They don't do third-party administration. I'm out. Like, those are 2 simple due diligence checks. Simple. There's a lot more due diligence, but like, I'm going to invest in your fund. Do you guys do annual audits every year? Third party, I'm not asking. I'm just saying in general. And if you're like, yes, I'm like, okay, I will go to the next phase. If you say no, sorry, it's a little too early for me. You could be my best friend in the world. Just get me back. Call me back in a few years when you guys do third-party audits. None of those funds that you guys have seen come out in the last little bit in the news, whatever, that have been bad, none of them did third-party audits. None of them did third-party administration. Very, very simple things to do. Bernie Madoff, by the way, do you guys know this? Bernie Madoff, $28 billion fraud, right? Biggest on Wall Street. 30 years he ran his fund. The dude was the president of the NASDAQ. He was giving hundreds of millions to charities. He was this great dude. Everyone loved Bernie Madoff. The SEC investigated Bernie twice. Found nothing. Bernie's a great guy. We all love Bernie. He never did an annual audit once for 30 years. People would ask, hey, do you have an audit? If you want an audit, you can go somewhere else. I don't do audits. We get 12% a year, 1% a month. It's just how we do it. Our firm's great. We're 28 billion or 30 billion, whatever they were. That's what we do. And then it took if you guys watch the documentary, it's crazy. It took an analyst, a guy at another firm, a competing firm, compiled all the data on why Bernie Madoff was a fraudster and gave it to the SEC. The SEC said, fine, we'll then investigate. They go investigate and boom, Bernie Madoff's this huge, huge Ponzi scheme, whatever, all collapses. Wild story. This doesn't happen just in Lee. This happens around the world. He never did an audit, though. 30 years, never did one audit on their fund. Very interesting, good due diligence. Okay, we got a few good things here. Anything else? Yeah. Yep. So I'll put like a little sub. But yeah, legal, structure, that kind of stuff. Like that? Okay. Let's do it. We can start with some of these. Let's go through some of these, and what I want to do as well, we'll have you guys, we can stand up, we can just talk face to face, we'll talk about your business. We can actually, some of you that ask these questions, we'll just go directly on you. Does that sound good? Good? Okay, I'm going to do, I think some of these will all dovetail into kind of a framework, and then I'll use that framework to answer a lot of these questions. Is that fair? Is that good with you guys? So give me like a few minutes, let me explain the framework of how I think about funds. Does that sound fair? So some of you know my story a little bit. I'll tell you very briefly. But I grew up here in Sandy, Utah, just down the road. I went on a church mission to Taiwan, which was amazing. I served 2 years in Taiwan. It was fantastic. Came home, went to BYU, just like the perfect Mormon Utah boy, like went to BYU, which is great. And I love BYU. And I got to BYU, and I said, I am going to, I'm in college to make money. My purpose of being in school is to make money. I'm taking classes like everything I'm doing, I'm like, if, the goal is to make money. People are like, follow your passion. I'm like, I don't know. Like everyone's passions eventually turned into a job, So you might as well pick a job that makes a lot of money, and then you can just spend money on your passions. So like, that's how I was like, I love skiing. I'm not going to make money skiing. I'm going to make money doing my money job, and then I'm going to go ski when I want to go ski, And if I don't like skiing anymore, great. I'll go snowmobiling, or I'll go on whatever. Okay. So I got to college. I started 6 businesses my first 2 years of college. I started a Chinese tutoring business. I started a website building company. We did an online marketing business. I wholesale 2 houses in real estate. Made $5,000 on each one of them. I wasn't like business ideas, by the way. These were businesses that started and like were trying to make money. My dad grabs me. He's like, Bridger, you're kind of like a chicken with your head cut off. And I grew up in a pretty normal house in Sandy. My dad sits me down and says, you should go meet with my business partner. I go drive to this guy's house, beautiful, gorgeous mansion up on the bench up here, huge house. I walk in the doors, I come sit down with this guy. And again, my dad drove a beat up car with a dent in the door, and I drive to his partner's house, this beautiful, white, gorgeous mansion. And I walk in this thing, and he's got a wine cellar in the basement, basketball court downstairs, the pool, cars, like this huge thing. And I'm like, dang. I'm like, how did you do this? Like, how did you get all of this? And he goes, we run an investment fund. And a number of years ago, we started this fund in real estate. And currently we manage roughly, I'll use my iPad here, but $8 billion in real estate right now. Which, to put that in perspective, you guys know Cardone Capital, Grant Cardone? They manage right now roughly $4 billion. Let me make this bigger. $4 billion. So at the time, they were 2 times bigger than Cardone Capital. Today, they're roughly $50 billion, their firm. Huge, right? To put that in perspective. And I was like, dang, can I learn about funds? Some of you guys have heard the story, but I asked him to learn about funds. And he goes, go talk to your dad. Your dad knows way more about this than I do. I said, no, my dad is broke. My dad drives a crappy car. You live in a big mansion. I want to learn from you. And he goes, Bridger, sorry to break it to you, but me and your dad make about the same amount of money. And my chin dropped to the floor. I was like, huh? Like, come again? He's like, yeah, me and your dad are pretty much equal business partners in this business. Like, go talk to him. I left the dude's house. I drove straight to my dad's house. I was like, Dad, what the heck? Like, what's going on? Like, why haven't I been able to order like dessert at the restaurant for the past decade? Because it's too expensive. We're trying to save money. And you're running a $8 billion fund. Like, where's the disconnect? Anyways, to make a long story short, my dad started teaching me about funds. We'd get on the whiteboard, and he started to teach me how funds were built, how they're put together, how they structured their funds. My dad grew up in North Las Vegas, never worked on Wall Street, never had an Ivy League degree, just figured this game out, and eventually started a fund that got bigger and bigger. He's now retired. He's been retired for years, and they've done extremely well as a firm. And so my dad started to pull out the whiteboard and teach me some of these things. Every Sunday night I'd go to his house and learn these types of things. The fund management world, Forbes puts out lists of billionaires. The number 1 category of billionaires that's created the most billionaires is investment funds. Number 2 is tech. Number 3 is fashion. Now, tech has some outliers, Mark Zuckerberg or Jeff Bezos, but that's just a handful of people. The vast majority of billionaires are made through running investment firms. It's an interesting quote. You know, you've heard like most millionaires made it through real estate. You guys heard that before? Most millionaires became millionaires by owning real estate. Most billionaires became billionaires by private equity, by owning businesses and or money management. This is the game you want to be in. My dad told me the same thing. You want to be in this game. Of all the games on earth that we could play, concrete, you could go into be a chef, you could build a Chinese tutoring business, or you could build a fund. And if you're going to devote your life to something in a career, you might as well devote it to something that's going to has, you know, unlimited upside. And so I was like, hey, I'm in. So he started to teach me some of these things about funds. And to wrap this story up, I started to, you know, when you learn about something, you start to recognize that thing in your life. Anybody bought it like a new car before, and all of a sudden you start seeing that car driving around everywhere? It's not like there's magically more F-150s out there. It's just that the fact that you start paying attention to those cars that are driving around, right? Same thing was true with me about funds. The moment I learned about funds, I started to see everything in the world through the lens of a fund. You guys heard that from me earlier, right? All these funds that control everything. When you start learning about funds, you start seeing this everywhere. And so I was in college at BYU. I was working at a company. I was an intern there and I was working there. And I found an opportunity where I could launch a fund in that company. They needed debt financing. They had clients coming through that needed short-term loans. And I said, what if we did a fund that financed these clients? Talked to the business owners. They liked the idea. I pitched my dad. He loved the idea. We started to put together this fund. I'm 22 at the time. I'm like, this is going to be sweet. We're going to raise money. We're going to put loans out and do this whole thing. So I got it all structured. I was like ready to go. I did all the legal, and we'll talk about this in a second. I got like my team kind of set up, licenses. I figured this all thing out. My dad definitely helped me a ton. Then I hit this roadblock like, crap. How do I raise capital? And I thought, duh, I'll go pitch my dad. You know, some of you guys have heard the story, but I'm like, I'll pitch my dad. So I go, oh my God, my dad apparently has tons of money, doesn't spend it on us kids, you know. We've been to like, you know, we'd never travel, we never go anywhere. Like my dad drives a crappy car, like we don't do anything. But so my dad's probably got money stacked somewhere. Like I got to go find it. So I go pitch my dad for money. Late Sunday night, I sat across from him at his home little desk and I said, Dad, how would you like to be our first investor into our fund? My dad says, I have the money to invest, but if I invest in your fund, it would ruin the experience of you raising money on your own. This is a crutch that you'll never be able to recover from. And if I invest in your fund, it would, you know, ruin this experience. He said no. And I kicked me out, kind of with my tail between my legs a little bit. And I was like, man, I couldn't close my own dad, you know. But I took that and I said, well, shoot, what can I figure this thing out? And I went out and talked to everybody I knew. My first little fund I put together at 22 years old was $49,500 from like 7 investors. So average check size was like $6,000, right? If you do the math, $7,000, which was teeny. That's like a micro fund, but it was enough to get started. And we did these little short-term loans. The loans turned out to be like super successful. Our first group of investors got a 64% return on their money. Small amount of money, but good return, right? Like I mentioned earlier, small fund managers it's easier to find alpha because you're in these small niches. We then kind of transitioned that fund into what we called Fund 2. Is the same strategy. We raised and deployed millions of dollars out of that fund over the next 3.5 years. I think our net returns to investors was 62, 47, and 36% cash on cash returns for those 3 years. So pretty good returns. We then had a competitor come and buy us, and I sold that fund. I exited that fund. So we can talk about that if you guys want exiting a fund, which is kind of uncommon. But we sold that fund out, paid back all of our investors, and it turned out awesome. During that process, a lot of people started to ask myself and my dad and my brother, who's an investment funds attorney, how did you guys do this? How did you guys, like you're in Utah for crying out loud. How did people in Utah build funds? And so we started this thing called Fund Launch, is Investment Fund Seekers at the time, just a small little online course that turned into a bigger course and then turned into now a full incubator where we help people launch their funds. We've had 100,000 people take one of our courses, which is just bonkers. We throw these multi-thousand person events. It's like, I'm shocked about how many people like this is affected. It's been amazing to be a part of. And then furthermore, we've launched 2 funds since then. I run Ugly Unicorn with Dan Young, manage about 25 million, like I said earlier. And then Fund Launch Partners, we just raised a $30 million round, oversubscribed, just closed on that last couple weeks that we're investing down to our students. So, and finally and now we've kind of transitioned Fund Launch. Really, we used to kind of have courses. We don't really do courses that much anymore. We're more of an incubator. So someone would come into Fund Launch, our thing is upstairs. You would come in and we think tank your fund for you. So I'm going to walk you through this process that we do in a second, but we do it with you. We have 8 different law firms that think tank someone's fund. We have partners that build your pitch deck for you. We have a capital committee where you can go and try to raise capital from. We have 15 coaches that think tank your fund, and then we launch that fund at the end. And we've launched over 300 funds in fund launch over the last couple of years. We're launching about 2 funds per week at that rate, which is pretty cool. So we're kind of transitioning to a full-out incubator that incubates funds to launch. And then the best of those funds, we write checks into. So we'll write $250,000, $1 million, $2 million checks into these firms as they graduate. Does that make sense? So that's kind of the background. Welcome in, you guys. Come grab a seat. So with that, let's answer some of these questions here that you guys put on the board. So it's funny, my dad, well, let me just start from the beginning, really, really simple here, and then we'll have some of these questions. What is a fund? Anybody wondering that question? What is a fund? Are you guys all good on that? Yes or no? You guys are good? Good to go. What is a fund? Private equity, hedge funds, venture capital funds. All it really is just a pool of money. Investors are putting money into this pool, and then we're going and buying assets with that kind of stuff. So you guys are all past that stage. So let's dive into this process of launching funds. Most people, when they want to set up a fund, jump to, we kind of, you're seeing the end result here, but I usually have this pop in, but we developed, or I guess coined, this concept called the fund launch formula, which is a 4-step formula on how people raise, or how we launch funds. Most people, step 1, they want to go do legal. Who asked the question about legal? Right here, right? Most people think, I'm going to go build a fund. Step 1, I'm going to go hire some lawyers and go build the fund docs, which I always tell them, like, hold on. Before you go hire lawyers, you can do that. But there's usually a lot of process that we do beforehand to help go and make that process go a lot better. And let me explain why. I had a friend, he went and hired a lawyer first. He's a guy here in Utah. He hired a lawyer. Lawyers generally for a fund are going to charge you initially $30,000 to $50,000. Can you guys see that? Okay. 30, 50 grand to launch your fund. He then was like, I'm doing this cool fund. I'm so excited. He then went and tried to raise capital. And the capital, went and talked to investors. Investors gave him feedback. Hey, you should change your fees. I wonder, I'm doing due diligence. What if you tweaked it a little bit like that? So then he went to what we call the frame stage of the deal phase and kept tweaking his fund over the next 6 to 8 months with the lawyer. So every time he tweaked the fund, he'd go back to the lawyer, say, hey, I want to restructure my stuff. The lawyer would charge him, $850 per hour. And great, yeah, we can tweak your docs. And they tweak the docs. They kind of did this circle over and over again. By the end, he told me his fund, he did this enough times, he spent $500,000 on legal docs because he did this process backwards. Now, you can still do it, but it 10x the cost of his fund. What we, after interviewing hundreds of fund managers, we found what we call the entrepreneur's way to launch a fund. We developed this thing called the fund launch formula. And this process is, instead of going to lawyers first, what we do is we flip that on its head. You can obviously see it written out here. Step number 1 is we go and we vet the deal. What we call, we really go and think through and do deep due diligence on the deal or the strategy. Once that strategy is figured out and processed in the right way, and I'll share in a minute, this is kind of the stuff we go through. We'll go through risk, control, return, how we're going to build our edge in our firm, that kind of stuff, okay? We then go to the frame stage. Are you going to raise from international investors here? We can talk about this in a second. What kind of waterfall structure are you going to do? Are you going to have, a pref, catch up, carried interest? Like, what are you going to do here? Are you going to run a GP-LP structure? Are you going to have a management entity here? How are you going to structure your LP and PPM? Are you going to run a Reg D 506B or 506C? You're going to do a 3C1, 3C5, 3C7 fund. All this kind of stuff we think through beforehand. Instead of letting the lawyer, because most people right now, well, hold on, what's a 3C7 fund? And a lawyer will go, oh, let me tell you about it. And lawyers generally talk really slow, and they get on their whiteboard, and they bill you $850 an hour. Okay, great. And then, oh yeah, should we be an investment advisor, a registered investment advisor, or an ERA? Oh, let me explain to you on the whiteboard. Let's get on a call. Let's get my 2 associates on so I can bill their hourly as well. You know what I'm talking about? And I'm like, why are your associates on here? They're 150 an hour each, and I'm $850. It's like, oh my gosh, that's how you spend $500,000 launching a fund when it could cost you 20 grand or 30 grand. Okay. once this is framed out, what we do is then we put this together. You can put it together in like a pitch deck or like a PDF, whatever you want to call it. Go and pitch investors. Get feedback from real world investors. Your fund is not going to be perfect day one. This is like any business, right? It's never going to be perfect. So get feedback from here, the capital raising stage. Go talk to real world investors and mentors. So what I would do, I'm going to give you a real example. And sorry, I'll finish this up. And then you go back and you edit based on what they say. So for example, our fund with Ugly Unicorn. Okay, Ugly Unicorn was originally going to be a real estate fund. You know me and Dan? We were going to do real estate. This is during COVID. We had this idea, what if we bought all these malls are empty? What if we hadn't bought these malls and we repurposed them into like a higher and better use? We could put storage units in them. We could put these like mixed use data centers. Like we could do all sorts of stuff with this interesting real estate that is worth nothing right now because COVID shut everything down. Not a bad idea, right? And we had all these really distressed retail kind of mall spaces that were just begging to be bought. And the debt on them was like, it was almost free debt. And we're like, frick, this is a great opportunity, right? Like everybody else, like this is kind of cool. So we put together a team. We're going to talk about teams in a minute. We went and framed this thing out. We like decided on how we're going to structure the fund. We then went and we called up some of our mentors. So I'd call a mentor of mine and say, hey, Joe, we got this interesting fund. Do you have 11 minutes? I want to run this. I know you invest in a lot of funds. I want you to give me 11 minutes to pitch you. And then 5 minutes, I want you to just pick it apart and tell me if I'm barking up the right tree or not. Do you have 15 minutes for me that we could do something like that? And they're like, yeah, Bridger, I got 15 minutes for you. So great. We'd hop on. Usually it'd end up being 30 or 40 minutes, right? But I'd frame it that way of 15 minutes. And what they do, they'd hop on and say, well, and I'd say, really? Most of the time, this is what they'll do. I talk to Joe. Joe's my imaginary investor here. But I'd talk to Joe. Hey, Bridger, you guys are awesome, man. I love what you guys are doing. Yeah, this is great. And I go, Joe, thanks, man, so much. What do you think? Any holes? No, you guys are doing it great. That's awesome. Okay, Joe, well, we're raising money. Do we want to put you down for a $250,000 investment? Well, I don't know if I can right now. I don't know. Well, Joe, what would hold you back from investing? Well, Joe, come on, give it to me straight. Okay, well, your deal sucks, dude. Like your risk control returns way off. And then he'd tell me the real, That's how it always went. They're really nice at the beginning. And you got to ask them like 3 times. And they go, okay, well, let me actually tell you. You structured this thing way weird. Your whole thing, you don't have a distinct edge. There's a competitor down the street doing the same thing. Like, I don't want, And you go, wow, that's very useful. Thank you, Joe. And I'd go back. And so, well, Joe, what if I tweaked some of those things? What if we brought a new partner, a new construction firm? Would that change your answer? Yeah, maybe. So I would go back to the deal phase, change kind of my team and structure, change my edge a little bit. And then, Joe, can I come back to you in a few weeks and we can try this again, see if it goes better? And Joe's a mentor of mine. Sure, yeah, come back in a few weeks. And we did this process over and over and over again. Does that make sense? This is working with, like in any business, like in tech, you're working with your customer, right, to build a product that they want. You see this with a lot of businesses. But when we get to funds, most people forget this. They believe, I'm just going to build a fund and they will come. People will just love it. They love me. In reality, most people don't think through the hard truth of like, really, what's your unique edge? Is this making sense? You guys, am I barking up the right tree right here? And then, back to Ugly Unicorn. Let me finish that story. So we're going to do real estate. We talked to like 10 mentors. Everyone hated it. We couldn't raise $1. Like we literally couldn't raise $1. And it was during COVID. People were obviously very fearful during COVID. They wanted to hold on to their dollar. We just couldn't budge. So I said, Dan, let's go back to the drawing board. Let's build a different team. And I was like, Dan, you're phenomenal. Like all he was doing all day was just trading crypto. He's like amazing at crypto. He's done crypto all the way back to 2013. He had the largest crypto mining facility in the state of Utah. Huge warehouse, like as big as this room, full of crypto miners in 2013. He's like, Dan, you've crushed it in crypto. What if we built a team around something like that? And he's like, that would be phenomenal. And so we started to build that together. We did the same process. We went through the deal phase, went through the frame phase, went through the capital raise. People loved it. We back-tested portfolios. We did all this analysis. We went and talked to the same people. I was like, dude, I'm in. We raised roughly $10 million in our initial launch, like boom, like that. And the first fund, we couldn't raise literally $1. And so this is the frame I wanted to set up for how we answer some of these questions. Some of your funds might not be the right fit. They might not be the right one, but if you work through this process, then finally, when you get that we got verbal commitments first, then we went to legal. Then we call up the lawyers and say, hey, I want XYZ with a drink and a side of fries. And they go, yeah, I want a Reg D 506B fund. I want to do this kind of catch-up carried interest pref, all that kind of stuff. GPLP structure, come on in. And he's like, great, I can build it for you. Our fund costs us about $15,000 to build. Normally that same lawyer would charge $30,000 to $40,000 to build a fund. He built it for us for like 10 to 15 grand because we knew what we wanted. It's pretty simple. They're just, yeah, you bill by the hour, right? I've already figured out what you need. Is that making sense? Follow along? Okay. So hopefully this is a decent frame that we can kind of answer some of these questions and work from. We've used this formula over and over and over again to launch every fund we've done out of our, because it's just been so consistent for how it works and how we can move through a process in a deal. This is a similar, I'll share one more analogy here and then we'll answer some of your questions. This is kind of my analogy right here. All of you right now could go build legal docs. All of you could go hire a lawyer, just build a fund. It's kind of like buying a platter off the shelf. All of you can go to the store and just buy a platter, but what's on the platter matters a lot. Can you build like a beautiful Gordon Ramsay meal, or is it going to be like a stinky fish? A lot of us in our community and stuff, it's their first time kind of doing a fund. They don't really know the difference sometimes between these two things. And they go launch a fund. They go, man, I can't raise capital. No one wants to put money in my deal. And I look at it and go, man, you got a stinky fish, dude. There's nothing compelling about your offer. Can we make a beautiful Gordon Ramsay meal? What's on the documents, what's on the platter is way more important. Is this making sense? Follow along? Okay. So let's hit on some of these questions. Does that sound good? Worth our time? Okay. Let's do this. Everyone stand up for me. Just shake it out for a second. We've been sitting for a while. And then let's just start whiteboarding stuff out. We'll talk about each one of these. Stretch it out for a second. We've got actually drinks over here. And by the way, all the t-shirts and stuff are all for free. Just grab one. I mean, don't take like 4. Just take one for yourself if you can. But this is just extra from our events, stuff like that. Okay. You guys feeling good? Stretched out a little bit? Okay, let's dive in. We got capital raising here as our first question from Ethan, correct? So on capital raising, Ethan, what have you done right now to raise capital? What's been your current process? Give me the sense of where you're at right now with capital raising.
Current process is mainly based in SBA loans. And so seeking the equity injection, usually 10% on a $5 million loan, that comes just from raw cash. And so that's the capital raise right there. We have then partners that can match those funds, but then getting above that $10 to $13 million mark to 25, that's what we have an opportunity for a $25 million deal. You can't do SBA loans for that. It simply has to be private equity.
Let me ask you real quick. So you've never really raised equity then, only debt through SBA loans. Is that correct?
It's debt through SBA loans, but then the equity injection, that just has to be cash. And so we have raised that.
You have done that. Oh, yeah. So how much, just give me to date, how much equity have you raised to date? And then how much debt through SBA loans have you raised? Does that make sense? Rough numbers are fine. Like $1 to $2 million? Okay. So you've raised $1 to $2 million from equity. And then how much through SBA? About $15 million. So $15 million through SBA debt. Which, by the way, if people don't know, this is a very cool debt option. SBA is some of the cheapest money in the country. And what kind of rates you guys get? 1.75 back in the day, and what today? What are they running at today? Do you know? 6 to 7. Pretty good debt to go and acquire things. I mean, pretty awesome debt. Now you got to raise some equity behind it. You got to have some financials. They got to do due diligence on you. But this is a very interesting opportunity. SBA loans, and again, they're $5 to $10 million range. So the question is from you: hey, these loans they cap out from the SBA. Oh, it's personally guaranteed too. Yeah. So they just cap out. You just can't guarantee that much. So how do we go do a $25 million raise or things like that? So let's talk about this. It's a good question. Is there a ratio that they run on a personal guarantee to SBA? Or how much you're asking equity raise to SBA? Is that what you're asking? Yeah, is it? Yeah, go ahead. Grab this mic real quick.
So most SBAs, this is what I do in my small business side, is about 20%, but there's some lenders that will go up to 10%, just depending on how it's structured end amount. No, for the actual debt. So like, let's say you want to do a $10 million SBA, you would have to put in $2 million of your own money. Right. Right.
So anywhere between 10 and 20% down. Think of it like a more 10% down, and we'll finance the rest, right? You cannot file bankruptcy. Yeah, they are personally guaranteed, and they go through a bankruptcy. So you're tied to this loan. I mean, you got to make it work. Yeah, you can't just grab the debt and then bankrupt, and then you can't get rid of the student loan debt and SBA. Good point. So interesting debt line here. Well, let's do this. We're already talking. What are some other financing options? Now, are you asking more on the debt side or on the equity side for this question? More equity injection. Great. Let's talk about that for a minute. And I think the rest of the group might have the same thing. Like, how do I raise more equity? Now, debt finance, there's a lot of options. SBA is one. I'm sure this group could highlight maybe some credit unions or other places that you could find debt or maybe private money lending. Right now, private credit's blown up because interest rates are so high. So private credit or private lenders lending, and there's hard money lenders that are like way expensive, but there's kind of this in-between group as well that'll lend on a business like this. It's not the SBA, but other groups as well. It's a very hot asset class because getting a loan from a bank is somewhat expensive. So you're looking for alternative routes right now in private credit. So I'm going to share for a second here on a framework around capital raising. Now I'm going to share this. There's about 1,000 different ways to raise capital. All of us know that. There's different avenues, and I'm not going to tell you there's one right thing everyone needs to do, because there's just different things that work for different people. We have a guy in our group right now in Fund Launch. I don't know how he did this. He found this group of like 1,000 dentists online, and they meet together. It's like a mastermind group. I don't know. He won't tell me the name because it's like his group, but they meet together. And he goes like once a quarter and pitches this group. And he's like a former dentist, and he just can speak their language. He's raised tens of millions of dollars online from this. I think it's a Facebook group or like an online group, all of dentists. That's like the only way he's ever raised capital before. And he just goes to that well every time. Other people are really good at going to like events and meeting people and talking people up. Other people are terrible at events and really good at going to, institutional investors and talking that language, right? So let me give you a few frameworks of how to think about capital raising. We'll see what fits for you. Does that sound fair, Ethan? So looking through here, again, we want to make sure we're building something really good at the beginning. That's the biggest step. Have a good fund. Like, capital raising gets way easier when you have a really good deal. It's much harder when you have a bad deal, right? But let's just talk. So first thing I'll tell you, just have a really good deal. It's got to be amazing. But let's talk specifically capital raising. So there's 3 different types of groups you'll kind of raise capital from. You have what they call high net worth family offices and institutions, and they all write different checks. So it's funny, with Fund Launch Partners, we were talking to some big family offices and big institutions. Our fund is $30 million. And they're like, oh, our minimum check size is $20 million. And we can only be 10% of the fund. So you have to be raising a $200 million fund for us to consider you. Sorry. And they're like, we love you guys. Call us back in a few years. We'd love to invest when you guys go raise a $200 million fund. We had 2 groups tell us that. I'm like, oh, okay. But they just per their mandate, they can't even invest. So it's important to make sure you're targeting the right group. For your raise, you're probably targeting down on this range. High net worths or small family offices that can write checks, $1 to $5 million checks or even less, right? Correct? Now, furthermore, I like using this framework. It's already in front of you right here. I'm not going to make it hide or whatever. Hopefully you can see it right there. So I call this the 3 stages of raising capital. There's 3 distinct stages that all of us go through when we're raising capital. Number 1, am I even around the people with money? Like, am I in what I call the room? Like, are you around people with capital? Okay. After you're around people with capital, okay, maybe you might be in the right room, but do those people see you as someone who actually could manage money for them? I have a buddy, grew up in a really rich family, wealthy family. He gets in a lot of good rooms. He's in the room, but no one sees him as a guy that could raise money. They're just that kid's son, and he's just kind of the guy that shows up. You know what I mean? There's a difference between being in the room and then being someone in the room that actually you respect and see I could what I call connect with that person and see them someone that actually could manage money for me, which then brings you over to what I call the close phase. This is the phase where you have like the pitch deck, you're in the boardroom, actually closing someone on the funnel. We have a full funnel here of like how we close. It's kind of blurry. How we close investors. Okay, does that make sense? Those 3 stages. Yeah. Yes. Okay. So I'll go a little bit deeper, and then I'm going to ask you a few questions, Ethan. So when I think about these 3 stages, well, actually, Ethan, let me ask you right now: which stage do you think you're lacking the most? Which one are you best at, and which one are you lacking the most? Are you getting in the rooms, connecting the rooms, and closing the rooms? Which ones are you best at? Which one are you worst at?
Raising equity, I'd say we can get in the rooms. It's getting in the right rooms, and so that's why I say that it's that gap. We've gotten in big rooms, but then, like you were talking about, a small deal is $25 million. That's a whole different. That's what I say is it would needing to get in the right rooms.
Yes, that would be probably the first one, number one. And which one are you best at, do you think?
Oh, connecting.
So once you're in the right room, you're pretty good.
Oh yeah, very. Yeah.
And then close is kind of the middle one. Cool. So if you didn't hear that, connecting you're the best at. Number 1, room, that's the worst at, and then close was kind of the middle. Might be worth you guys doing the same thing for yours. So let's talk about that for a second. So how do we get in the right rooms? You mentioned you get into good rooms, but a lot of these rooms are up here. You're talking to people that just are way too big for what you're doing. So how do I get in the better rooms? And I would love to do, maybe this group can think tank some rooms for Ethan to get in from Atlanta. And we're in Utah here, but we can tell you some Utah rooms. You can tell some Atlanta rooms we can get into. I think of 2, now again, this is a framework to work from, 2 different ways to get into rooms. And you can already see it on the screen here. You can work your way into those rooms, or you can buy your way into those rooms. Now, you've already gotten to good rooms, but then targeting the right rooms as well. I call it work versus buy because there's rooms that you can work your way into. Today, none of you had to come pay to be here. You had to wake up and get here. Like, that was work. You had to work. You had to be on LinkedIn and see a post from me or whatever and get here. There's networking groups or real estate meetups. These are going to be a mixed bag, but you're just going to try a lot of rooms to just see what fits, right? You're working your way into those rooms. Now, there's the other side is buying your way into the rooms. Sorry, it's a little blurry here, but we'll roll with it. This first one, if you can't read that, says Ferrari Club, okay? If you buy a Ferrari, you can join the Ferrari Club of Atlanta. The cost of admission, guess what, is owning a Ferrari. And everyone else in the Ferrari Club of Miami, guess what they have? Ferraris, okay? Like, it's a good group to be with, right? You can go, there's a number of these types of groups. I've joined MASH. Have you ever joined a mastermind before? Something like that? So I joined one pretty much every year for the last 6 years. One was $24,000 a year, $30,000 a year. Another one was $15,000 for a year. I joined one last year, was $150,000 for 1 year. We just joined one, $250,000 for a year. That was the one I was with Tony Robbins, that group. $250,000 to be in that room. There's 3 events a year. That's it. I mean, I'm still doing it. Yeah, I think it's worth, at least for the business I'm in and what I'm doing, because you might say that's absurd, Bridger. Why would you spend $250,000 going to 3 events? Well, everyone else there has also paid $250,000 to be there. Pretty good group to be with. You know what I mean? That's the nature of it. It's, there are 3 events. We do these really cool things. You get to meet interesting people. I got insights. If I do at our level of business, if we get 1 or 2 really good insights that change our business, we'll make $250,000 in a month or 2, just from those little tweaks. So is it worth the investment? Yes. At our stage of business, yes. Is that a lot of money? Yeah. For Bridger, I'm not up here like, I'm so rich. That's a lot of money for me. That's a GT3 RS, Mace, right? That's a nice car, And dang, like $250,000, but man, can we make it worth the investment? And so far, the ones I've joined in the past have been worth the investment. Like, when I look back, I'm like, I met that guy who made me do this, and I did this, and I changed my team this way, and our business grew like this. Shoot, that came because I joined a group for $30,000 back in 2021. Like, dang. So, being in the right room, buying the right rooms. I'll give you another example. My dad, this one right here, some of you guys have heard the story, but this is in Utah. He did this when they were starting their first fund back in 2005. They're in the small, teeny little office, him and his partner. And my dad's very conservative, as you can tell from his stories. He's a very conservative guy. His partner is more like, we're spending money, we're going to have fun, like blah, blah, blah. His partner comes home, comes to the office one day and says, John, I just spent, I think it was $35,000 on box seats to the Utah Jazz. And my dad's like, what? With inflation, $35,000, that's, still a lot of money. And they're like, we have no money. Like, what, like, you took our whole piggy bank, you just spent it on 4 box seat tickets to the Jazz. My dad was pretty mad. And Paul's like, hold on, before you go after me, We keep calling into these CEOs and wealth people, and we can't get a hold of them. They always turn us away. They got a receptionist. They got somebody that says they're busy. But if we call in and say, hey, Mrs. Johnson, she's a local wealthy woman in the area. Mrs. Johnson, hey, Mrs. Johnson, assistant, I've got 2 tickets tonight. The Lakers are in town. We got LeBron and Luca here, and we'd love for Mrs. Johnson or her husband to come. We've got parking passes, dinner beforehand. Does she want to come to the game tomorrow night with her husband? The odds of success go way up to get in the right room, right? And so they started to do that, and they went from getting kicked out of the receptionist's office to, yeah, what time do we need to be there? Yeah, we'll show up at parking's at 6:15. We got the dinner beforehand. Game starts at 7. Great, we'll be there. And then they had 3 hours to chat them up and talk to both them and their spouse about what's going on in their life, what's important to them. I was talking to my dad. He equated they did it for about 3 years. Those box seats they raised about $70 million. When they had really never raised money before. That was their first time really going out and raise money. $70 million they raised in Utah in 2005, 6, 7, I think, right then. The Jazz had to run Darren Williams and Carlos Boozer, and we were pretty decent. So that's true. We actually got pitched to buy some tickets the other day with me and my in-laws, and then my father-in-law's like, I'm not why would I buy these tickets? They were like really cheap too, like for like season tickets in the lower bowl, and I don't want to see the Jazz. So maybe do something. Maybe the hockey club is better. Maybe something different. But maybe we'll get Cooper Flag. This is the year, right? Aren't we supposed to get the draft picks this year? Jazz 2029 is going to be sweet, Mace. I keep telling Mason 2029 Jazz is going to be phenomenal. We just got to wait a few more years for them to rebuild. We keep rebuilding. All right, so that's the idea of pay to play networking. Is that making sense? So there's a number of rooms. Again, you can work your way into those rooms, or you can buy your way into the rooms. I always, at least for me, I suggest people do a mix. I think come to stuff like this that's free, and you'll meet some incredible. You've already said you met 2 incredible people here, which is amazing. And then I would do a mix of, I'm going to try a few rooms. And you're not going to hit on every room you go to, but I would start buying and trying in some rooms to get in the right room. Okay, is this helpful? Helpful for anybody? Get in the right room. Now, once you're in the room, connect. How do I actually connect? I'm in the room. How do I meet people and get to the right point of getting them warmed up to the idea of going and closing? You mentioned this was your best one. Do you want to share what you do? How do you connect? Once you're in the room, how do you feel like you connect and warm people up to the idea that they're ready to talk to you and close? Are you comfortable sharing, Ethan? Okay, think for a second. Anybody else want to share? There's no right or wrong answers. A lot of different ways to meet people. I'll share one quickly, and then maybe give you guys a few ideas, and I'm going to share the mic. I want to hear from y'all. When I go to a networking event, I go to how to win friends and influence people, right? Like, how do you meet people and do stuff? I always want to talk about them, like what's important to them. How can I solve their problems, right? That's what I'm always thinking about in my brain. How do I solve their problems? So generally, I'll meet somebody. Let's say me and Ethan met sorry, you keep thinking. We'll meet. What's your name? Jerry. Hey, Jerry. Good to meet you. So I'm going to ask you about Jerry. Tell me about your business, all that kind of stuff. We're going to talk for a few minutes. And generally, Jerry will ask me about my business, right? That's usually, what do you do? I usually will say, I run 2 investment funds. We manage about $50 million in capital right now. And if you're starting a fund, I'd say, hey, I'm putting together a fund right now. We're looking to buy these certain deals, X, Y, and Z deals. But hey, I'm not here to talk about that. What I usually say is this. I said, well, Jerry, good to meet you. We'll talk for 20, 30 minutes. We'll talk about your kids, your family, whatever. If we find a connection, if I think, you're someone I want to talk to. And I'll say, Jerry, you sound like a guy that does tons of deals. By the nature of me running a fund, I get pitched deals all the time. And I can't do them. My fund is in crypto and blockchain. But I get these amazing real estate deals all the time, and I just can't do them. It sounds like you're a guy that does deals. If I get a good deal across my desk, would it be okay if I forward it to you and your family office can look at it and you guys can just check it out? Would that be okay? Oh, absolutely. Love to see it. 9 times out of 10, that is the exact answer. Who doesn't want to look at good deals? I say, great. Well, let's do this. Let me share contact. Let me get your email. I'll keep your email, and I'll once I get a couple good deals, I'll shoot them your way. Does that sound fair? So we'll set this little arrangement up. We share an email, and I pull back, and I actually go, and you can see here, this is, again, one example. There's a lot of different ways to do this. But I'll start building a Google spreadsheet, like pretty simple, just of a list of emails. And legit, I do get a lot of deals just by the nature of, and all of you, once you start telling people you run a fund or you're building a fund, you get deals sent to you all the time. Hey, I got this pitch deck. And so look through them. And if I see a couple good ones, I'm going to forward them to Jerry. Hey, Jerry, good meeting you last week. I just forwarded you a deal that I got. It's in St. George, Utah. Take a look at it. And all of a sudden, Jerry goes, oh, Bridger's a guy who sends me, just forwards, he's a fund manager. He's sending me deals. He's a deal guy. I've gotten out of just I'm some guy you met in an event versus I'm now hopefully someone giving you value to your life. And I would tell, I don't have a dog in the race. I don't have any, just you guys can underwrite, but I think this deal looks pretty interesting. I thought you'd like to look at it. All of a sudden, hopefully my value's gone up a little bit. And over time, if I can nurture this, what I call a list here, could be text, it could be email, whatever. Eventually I'll say, hey, Jerry, I've got a good deal. It's called my fund. And hopefully we're friends by that point over a month or two. Hey, say, Jerry, we're doing another round. I don't know if you're interested, but I'm putting this out to everybody I know. If you have 15 minutes, I can walk you through it. Odds of success, I think, go up rather than down, right? He might still say no, but odds of success, I think, go up. That's one way you can connect with people in the room. There's other ways to do this. Oh, yeah. You want to share? Grab the mic here for a second, just so people on Zoom can hear you.
I was going to say, I currently do this. I got it from Bridger, stole an idea. But it works. It works really well, and I wanted to use it as a plug, where if you guys are needing help raising for a deal or have an investment opportunity, I run a fund of funds, and I would love to hear what your deal is if I would want to take it on. But if not, I'll put it on my email list and send it to my current subscribers. So just hit me up after this.
Remember your name one time? Isaac. Isaac doing Inception on the connecting phase, doing it right now. Clap it for Isaac, everybody. Well done. Well put. It's worked pretty well for you said, though. Yep. Yeah, tons of free value. How can I solve their problem, right? Actually, I'll do this right now. Actually, what popped in my mind, I met Tony Robbins like 2.5 weeks ago. He mentioned, if anybody has, he just off the hand said, like, oh, I'm looking for a Ferrari SP3 Daytona allocation. If you guys know that car, it's a $3.5 million car. It's a beautiful car. And he just off the cuff kind of said that, and I put that in my brain. And I was like, frick, how can I provide value to Tony Robbins? Everyone in the world wants to meet Tony Robbins. Can I be the guy that gets him that allocation? Right? So I texted a few friends that are really big car guys, like Supercar Ron, you know him. I texted him. I was like, do you have an allocation? Anybody who's got an allocation? He goes, I haven't got one yet. So if anybody has an SP3 Daytona allocation, let me know, and we can be friends with Tony Robbins. I have no idea. That's what I thought about too. I'm like, there's no way he's fitting in that car, but he wants one. So I'm like, all right, maybe they special fit it for him. I don't know, because they can't fit in those cars, but pretty cool. So that's, anyways, one example of the connection room. Other people have awesome techniques. And I'm okay at this. I'm not like a world class. That's one way I've done it. Other ways to build people on a list, to provide value, to help them in their life. Ethan, did you think of anything for you? Not yet? Or we got a few hands up here if you want to still think, but.
Every man is my superior in some way, in that I learn of him. When I walk in the room, I'm there to figure out how you're better than me at what you do and how you got that way. And it's genuine interest.
Right from How to Win Friends and Influence People right there. Every man's your superior. I love it. You had two hands here. Let's go here and then here.
Yeah, I was just going to do an idea that's worked on me that as we get into this capital raising. Being in these events, I've had a couple guys just hit me out after. They basically just sent me a book. It was a golf event, and he sent me a book on Johnny Miller and something. And then we'd talked about it, and anyway, I think that's a good way. Again, just providing a little value. I remember that guy to this day. And I haven't invested with him, but if I need it, I will. So.
Anybody ever received something like that? Like a random gift? There's a book called Giftology. Talks about this whole concept of how to give gifts and how to really help. People don't receive gifts that often in the mail, just randomly. The best way to do it is random like that. And it could be a book. It could be packages. I've received stuff like that before. Very cool. Very interesting. Thank you for sharing. Hand up here. Yeah, come just closer so we can get this cord over to you.
Speaking on gifts, I wasn't really going to mention this, but you know Matt Montague by chance? He's kind of a Utah County guy, wholesaler for Hartford funds. So I'm a 20-year financial advisor, raised and managed about $150 million. Just sold my book of business last year and decided to launch a fund. That's kind of my background. I'm doing a little status alignment right now. So basically, status alignment can be intimidating for some people because sometimes you just don't have it, right? But the advice I would give is, like, for instance, with your challenge that you're talking about, I found the very best way to get your clientele is through referrals. and that's actually an item I would probably add under either work or buy, is either some sort of.
We've got it here. It's all blurry down.
Oh, okay. But yeah, like you immediately have sort of a status alignment with the person you're talking to if you were referred to them by one of their friends or family, right? And so let's just say you knew
Explain status alignment real quick. People aren't familiar with that.
Yeah. Okay. So
Do it live if you want.
yeah. So basically, kind of to use a dating analogy, women date above their status or equal to their status. Men date equal to their status or below their status, which in the business world, kind of transitioning that to the business world, we tend to want to date equal or above. We date like women when it comes to business. And so if I meet somebody at an event and their status is like, hey, I'm just a new beginner, you know, in the back of your mind, subconsciously, you're like, well, I don't really want to do business with this person because they're not on my status, you know. But if they're, you know, talking about Ferraris and, you know, what they've done in the past and how successful they are, then obviously you're going to give them more time and attention. But it can be difficult and intimidating to have that, the ability to have status alignment if you just, you know, if you're inexperienced, if you just don't have the business background. But if you can get in and build a relationship with a few people, get a few deals, whether it's friends and family, and then lean on those relationships for future referrals, that's going to be the status alignment shortcut that you couldn't really get any other way. I mean, a lot of us can't afford to buy box tickets to Jazz games and whatnot to try to buy that status alignment. But building it through just basically relationship nurturing is a good way to do it as well.
Well, but remember your name? Adam. Clap for Adam, everybody. Adam, stay up here for a second. So yeah, this concept I've loved, and we'll double click on this for status alignment. But he talks about a flash roll. Oren Klaff, great book by the way. Flip the Script. If you guys haven't read it, phenomenal book. He talks about this concept like you just did at the beginning. You said, "Hey, you know." Kind of before I asked my question, hey, I run a $150 million RA. I just sold that book of business. I built it myself. All of a sudden, the whole room goes, oh, shoot. This is someone I probably need to pay attention to. And you did it really quick. It's 1 to 2 sentences. It's not you bragging about yourself for 10 minutes to everybody. But it's a what they call a flash roll, 2 to 3 sentences very quickly on, we're all meeting people. This event right now, you're meeting tons of people here today. And you're trying to gauge, who am I going to remember? I'm going to remember Ethan's name or remember, you know, Joe's name. Who am I going to remember? That's going to be valuable to me later. And that flash roll helps that a lot. Joe did that to me when he met me. He's like, oh, we just got a $250 million commitment to, and I was like, oh shoot, that's pretty cool. I'm gonna bring Joe on stage in a minute, right? You didn't do it in a cocky bragging way, but you brought it up in 2 to 3 sentences very quickly. I was like, oh dang, that's really cool, Joe. You know, you brought that up at the beginning of yours. It's similar to, I always use like the Justin Bieber analogy. If you come up to somebody, there's kind of 3 different statuses that people generally align, and maybe add to this. That's why I brought you back up here. So you can come over here if you want to draw a little bit. But like, imagine if, you know, you saw Justin Bieber out in the street. He just walks by right now. People have different reactions. Some people run up to Justin. Oh my gosh, Justin, I'm such a big fan of, oh my gosh, can we get a picture? Justin, his brain goes, this is a fan. I will treat them like a fan, which is, and he's probably nice. Oh yeah, we can grab a picture or whatever, and then moves on. He's not going to do a deal with a fan, right? There might be somebody else that comes up to Justin and says, Justin, hey, I'm a producer. I worked on a bunch of Drake songs and other stuff. Just wanted to say hi, introduce myself. You know, I helped Drake launch his last album. It was pretty cool. I just want to say hi to you. I've never met you in person before. It's not equal, but it's more in the same industry, right? At least somewhat. He's not like a fan, but it's a little bit higher than I think of a fan. Does that make sense? And then furthermore would be, you know, the top would be somebody that Justin looks up to. I don't know who Justin looks up to, but let's just call it like Dwayne "The Rock" Johnson. I don't know. And so it'd be like, oh, like it's kind of a mutual respect. Mark, you talked about it's, you know, Dwayne "The Rock" Johnson. They meet one another, and that's kind of a status alignment or increase. Anything you'd add to that?
No, I think you hit the nail on the head. But I recognize it can be intimidating for new guys and gals that are just trying to break into the industry, and they may not have the background to be able to walk around and drop status alignment tips and tricks just really casually when they meet people. But I'm sure with a little bit of practice, there's some areas you can do it. I mean, you know, you can look up little cues and ways to connect with people that maybe are a little bit lower hanging fruit. For instance, I don't know if a guy's got the F-150 and the right tires. Your status aligning around guns and your latest hunting expedition, right? So just that little connection point you're looking for. Going back to this Matt Montague gentleman who lives in Utah County, he sent me, talk about gifts, he sent me a really cool box full of cat toys and cat food because he heard me casually mention that we had got a cat. And I didn't bring it up. I just barely mentioned it. And he really impressed me. I ended up doing millions of dollars with this gentleman, millions of dollars over like 15 years because he so impressed me with this little attention to detail that I definitely wasn't expecting.
Thank you very much. One more time, clap it up. Thank you very much. Well put. I know we talked a lot about capital raising, but we'll move on here. But I think this is fun to talk about. 'Cause I love that the cat, all the stuff, and you can have status alignment in different ways. It doesn't have to be money. You can status alignment on kids, on cats, on guns, on sports. There's a lot of different ways you can get status alignment. All right. Now you might say, well, Bridger, that sounds hard. Yeah, it is hard. It's a reason not everyone's a billionaire. Like not everyone runs a fund. Not everyone's a billionaire. Not everyone's but if you do this right, I love it's a quote from Hormozy actually. It was funny. He's like, this one guy's talking to, he's like, man, this sounds like a lot of work. He's like, yeah, it's a lot of work. But if we do it right, they're going to pay us like $80 million. So is it worth doing the work? Like maybe, you know what I mean? Like, yeah, let's do it. Yeah, it's going to be hard. So, okay, we talked way too long on this. Let's go to some of these other ones. Sound good? Good to move on? Okay, I'm going to go a little bit faster if that's all right. And then we can work on people's like one-on-one stuff. We'll go from there. Capital raising done. Okay, let's talk about due diligence on deals. You mentioned this, Ginger, right? How do you do diligence on other funds? And also, furthermore, just on your own deals. Does that sound fair? Good way to look at it. Anybody else interested in that kind of question? We'll hit this for I'm going to go quick, okay? I'm going to go like 2 minutes on this. We developed a framework that I thought was very useful, and I'm going to share this with you guys. So on the deal phase, if you guys can see here, got my fancy iPad. All right, I'm going to roll down to risk control return. Anybody heard this concept before of asymmetrical risk? You guys heard of that before? It's a finance term. Some of you guys in finance have heard of this before. This is the concept, and I'm going to change colors here. I'll go black. Most of you have probably heard high risk, high what? High risk, high reward or return, right? Sorry, I'm drawing and typing at the same time. High risk, high reward, right? And then low risk, low reward. Gosh, sorry. I'm just going to not talk here. Asymmetrical risk. Okay, hold on. Let me type here. All right, high risk, high reward, low risk, low reward. Asymmetrical risk is, can you find some things that have relatively low risk for relatively high reward? Number one, is it possible? Number two, can we find it? The answer is yes, and hopefully yes on the second one. This is where fund managers make all their money. This is why fund managers exist. You were trying to find things that have asymmetrical risk. I was with Ray Dalio just a few months ago, status alignment. I was with Ray Dalio at a Greenwich Economic Forum. It's a small club. I paid $15,000 to be there. It was 200 of us. I got to meet Ray Dalio. It was really cool. He talked about this concept, so I'm status aligned in the room. He talked about this concept. He goes, we try to find in Bridgewater 10 to 15 uncorrelated assets and we found we can, if we have about 10 of those, we can lower our risk by 80% without losing our reward. That's how he structured one of the top performing hedge funds of all time. Okay, so this is possible. Yes, this is what fund managers do. This is what we are trying to do. Furthermore, I'll give you another example. Simple example, house flippers. Anybody flipped a house before, by the way? If you remember you guys? Okay, house flippers. If Bridger Pennington went and flipped a house, and I'm pitching you to invest in me flipping a house, I'm just telling you straight up, it's going to be high risk. I'm terrible with my hand. Like I'm just not a handyman. My family makes fun of me all the time. I'm just not. And I'm like, well, screw you guys. I'm just going to make money and I'll hire a handyman to come fix my gutter. Okay. That's how it goes in my family. They all like literally, my brother like always makes fun of me because he's really handy. He has all the tools and everything. And I have the tools, but I just like don't know how to use them really. And I just like, I'll just hire somebody. Okay. If I flipped a house, it would be high risk and maybe high reward, right? It would hopefully go well, maybe medium reward, right? Probably a lot riskier. However, who's flipped a lot of houses in here? Who's flipped the most? Just throw it out. How many houses have you flipped? Who raised their hand? Who's flipped a house? Worker. So you find flippers? Oh, you fund them. Okay. Yeah. Yep. Gotcha. Well, somebody that I have a buddy, he's flipped 300 houses. For him, flipping a house is low risk. The average house flip is about $65,000 a person makes on a house flip in America. That's that's a house flip. It's an average. It's because they're in a market that's pretty fractured. It's hard. And when I talked about, remember big fund managers versus small fund managers? They're in a small, it's a single family house. It takes a lot of energy and time to flip that house. When you get to bigger markets, you get what they call efficient market theory, where markets are perfectly efficient when you have huge amounts of money and they're super liquid. Down in small markets, they're usually very inefficient and fractured. Hence, we can find places that have asymmetrical risk. Y'all follow along? Yeah? So when I look at a deal, this is how I do it. Okay, I'm going to look at a deal. Anybody have a deal they're underwriting right now? Throw it out. Just yell it out. Anybody have a deal they're underwriting? Jerry's got a fingernail business, like a nail salon or what?
I am a semi-retired attorney, did over $1 billion with real estate, 85 to 205. And I felt something was going to happen, and 8, 9, 10, 11 got out, completely removed myself, went out and played, came back, looked for opportunities, and run across, for my fashionista wife, a problem in the artificial nail industry. She said they were terrible and unhealthy. Found a cosmetic dentist who had a solution, making a custom fitting from a scan that was removable and reusable. And I wasn't interested too much at that point, but then he said, well, they're spending $5 billion to $10 billion a year. I took an interest, I studied it. I have a capstone project at the University of Utah building out the proper production lab to produce these products now. We put them through proof of concept, they work well. We thought an Avon, a New Skin, Amerikay would be excited because it's a great lead generator. They are excited, but they don't want to produce them. So I was excited because it's very low risk. Our proof of concept showed that 60% of women want to try them, and over 75% once they try them want to use them forever. That's a scan that keeps them in. It's a low amount of capital for the people that build the production footprint, and then there will be ancillary business.
Okay, that gives us good context. So explain now the deal. Like, so if I'm investing in you, am I investing in the company? Am I investing into patents? Are we investing into franchise? Like, what are we actually buying and investing into? And give us the deal, and then we're going to run through it right here.
We're seeking $3 million to establish the lab that the capstone design team at the University of Utah is going to set up the blueprint for. And we're looking to put some equity into that. That will be an initial investment. Whoever comes in with that will have an opportunity to participate more as the company grows and splits into divisions for continuation maintenance products.
Keep it simple for this, but thank you very much. Okay, so hold on. Am I correct? $3 million investment to buy the lab equipment to produce, and then that's going to dovetail into the full company. Right. Is that correct? Yes. Good summary. Everyone got that? Okay, we're going to do this together. Thank you, Jerry. Congrats, by the way. It's a very cool business, it sounds like. That sounds very interesting. We're going to double click. I'm going to come back to you in a second. Okay, so let's just, with the basic knowledge we know as of 45 seconds, what I like to do here, I like to put down all the risks that are associated with this potential deal. Things that we can control, if you can see here, and things that we can't control. Both are important. Just because you can't control it doesn't mean it's not a risk, okay? Both are important. We're going to run it through and see how sensitive we are to these risks, and then we're going to drive a worst case, a base case, and a best case scenario out of them. So hopefully this makes sense. So let's start with the risks, though, on your business. So I know it's going to crush. The upside's amazing if it all works, but walk me through, maybe yell out, crowd, what are some risks associated with this investment? And we'll bucket them into things that we can and can't control. Operator risk. Perfect. Yeah, and that's something we can control. So operator risk. Like, who's the actual team behind it? That's a risk. Are they going to actually produce? Are they going to work hard? Like, what are they going to do? Keep yelling them out. What else? What are their risks? Sales? Yeah, can they actually sell this thing? What else? Yeah, unknown competition. with like that are also developing? Is there a lab at BYU developing the same thing, or at Utah State? You know, do we know those? And around the whole country, around the world, is somebody else going to come and disrupt us? Keep going. Yeah. Yeah. Will women actually adopt this? Now you mentioned you think so. There's case studies that show that, but it's still a risk, right? Adopt. Sorry, I'm trying to write and draw at the same time. It's pretty fun. Fun challenge for me. What else? Operator risk. These are some good ones. Sales, underwriting, comp. Adopt. Did I spell that? Adopt. Oh, I did it wrong. Adopt. Adoption risk. Let's go things we can't control. What are some risks that we can't control that are still important? Yeah, recession. What if we dip into a recession right now? What else? Supply chains. Yeah, what if we hit this trade war like we talked about earlier? Supply chain is just fractured. We can't even sell overseas. There's just all global trade just halts. What else? Yeah, regulations. What if there's some new laws that come out that, for whatever reason, there's some glue on here that hurts some, ecosystem and whatever, and we can't use it anymore. Okay. Regulators. Wars, like we can go down the list. We could do this for an hour. Like there could be a war could break out. I mean, we could have, anyways, a lot of stuff that can happen. Okay. Sound good? Give you a sense. I'm gonna go quick through this, but you would do this on your own deal. Then what we do next is say, okay, let's look at things that we can and can't control. Let's run it through a sensitivity matrix and let's see what drives out, pending all variables are the same, how it drives a worst case, base case, and best case scenario. Okay. And let's see if we can minimize some of these risks. So this is what I would do on a deal. Like if I was working with you, I'd say, all right, Jerry, let's look at operator risk. How can we mitigate that risk as a company? Any ideas?
As far as running the lab, be sure you have expertise, and that's where I have the capstone design team brings an amazing degree of expertise, state of the art.
Expertise. You got your University of Utah, but also is it just you that's going to be managing the money, or do you have partners?
I do have partners. One of my principal partners, who will probably be the president of the new, we'll start a new entity that's used to be at Houston. So he has amazing experience.
So you got a partner with really good experience. Yeah, that does really well. Yep. Cool. That'll help all those. And then we can go down sales risk, adoption risk. So we're going to see if we can minimize some of these risks. And then we're going to go through and say, okay, let's run a worst base and best case scenario for it. So let's go back to your, partner might be interesting. So if we run a best, like you land, like your partner just crushes it. Best case scenario, we do what, like we're $1 billion company, or like what's the best?
Well, again, I really appreciate getting the input so quickly on such a brief, and I can answer in detail every one of them was brought up because I've done a tremendous amount of.
I know, yeah, we know, yeah, and we're going really quick here. We're going, yeah, kind of a simple example. Yeah. So best case, and if you land the right partners, we're hitting $1 billion. Our base case, kind of in the middle, where we think all things will be equal. Where do you guys end up in a couple years? Kind of base case.
I tell people if it failed miserably, from my point of view, maybe 10 million, 20 million, 30 million.
Okay, so let's call it 10 to 20 million. It's kind of our base case. Worst case, it goes to zero, right? Probably.
Yeah, I don't think it could.
Don't think it could. So what is the worst case then? Do you have patents and stuff you could sell off? Like, let's say, and we're talking partner risk here. Let's say your partner dies. Let's say, you know what I mean? Like, let's say you get cancer, partner dies, whatever. We got to dissolve or wind this thing down. What is the worst case scenario that happens with this tech? Can we sell the patents? Like, what's kind of our worst case here?
Somebody's going to always run with it and make money with it. Worst case is I die, don't get to watch it. It's really that.
But as far as an investor, I'm investing in this business. What's my dollar amount worst case? Is it zero, or do you think there's actual no? There's hard value here. That the worst case we'd still. Yeah, we have liabilities too. Is it 50 grand as our worst case? All right, I'll throw like 50 grand in here. Does that sound okay? Okay. Well, this is healthy to do. So then we run through each one. Okay, what if a supply chain issue hits us? We're gonna run the same thing. So how sensitive are we to that? And maybe we're not sensitive. You know what? We don't need supply chains because we do everything, here in Utah, very local. And, it's still all this. We're not sensitive. So if someone asks you that question, no, we're not sensitive at all to supply chain.
We determined to not go to China after checking out China. And we do want to keep it as Utah, and we do want to keep it within the bounds of the United States.
Yep. Okay. So great, you've already mitigated that risk. So anyways, is this making sense as an analogy here? So you run through your own deals with this, because this is what investors will ask you. How sensitive are you to recession or regulators? Oh, we already ran a sensitivity matrix. You want to see it? This is what we think. This is our worst case, base case, and best case scenario based off of that. This helps you do a lot of deep underwriting on your deal. So I'm pointing at this when I should be pointing at this, to how to do this. Is this making sense? So when I'm underwriting a fund, back to Ginger's question, how can I look at their worst base and best case scenarios, and how sensitive are they to these risks, and do they actually have asymmetrical risk in this offering, or is there no asymmetrical risk? Have they underwritten this thing wrong, right? Do they actually, like me flipping a house has no asymmetrical risk at all, right? Yeah, hand. So what we'll do, usually put this in an Excel spreadsheet. It's much easier, a business like this, you're probably guessing a little bit more. A real estate fund, though, not as much. You can plug in rent rolls, operating costs. I mean, you can plug in and do a full. Essentially, it's your pro forma, and you're running a pro forma for a worst base and best case scenario. When launching a business, you can still do the same thing, or buying a business. Okay, what are my current operating costs, my risks there? How sensitive am I to these effects in the market that happen? If you're running a crumble store, you could run most of those pretty well through this. Any follow-ups to that? Does that make sense? Yeah, usually you're gonna spend some time building out a big Excel spreadsheet. I'm kind of doing it by hand here, but you're trying to put as many hard numbers as you can into this model to really try to find what it is. Great. Anything else, Ginger? Is that helpful? Okay, I like it. Let's do this. Let's do we'll hit a couple of these fast here. So, team. We had a question on team. Who asked that one? I think it was over here, right? In a fund, I see these three distinct roles in a team. So there are your expert investor, your fund, what I call, this is your person that's amazing at doing the certain deals. You have your fund manager, and you have what I call the money raiser, the person that's very good at raising capital or meeting people. This could be 3 people. It could be 10 people. It could be 2 people. But each one of these roles need to be solved. Now, double click on me. What specific? Maybe this. I'm going to ask the group your question because a lot of people have partners in here. Maybe go a little bit deeper on us. Finding partners, finding team.
So the problem was one of part of our group. He manages basically event and wedding buildings, and he's having a hard time finding people that will run each facility because he has a kind of people he's given equity to, and they're just not getting the vision and the output that he would like. And so just that part, like for myself, yeah.
So everyone hear that okay? So managing multiple locations, is it your question? Whose question is it then? Somebody else in your group had this question? Anyways, we won't call on them. We'll keep them private for now, but running different locations, different teams, hard time building those sub-managers, that second tier of management. Who else has done this in this room? Who else has built like a second tier management sub teams? Yeah. Do you want to answer this question? You're hitting the same thing. Are you guys partners? You guys are with your crumble stores. So you have a leader of a crumble store, and share this real quick. Yeah. What have you guys? Just give us what's happened so far and where you guys are at with that process.
So we have made our lives a lot harder we are across 4 different states for 12 locations. So we have multiple management teams for 4 states, but it's a pretty small portfolio, right? And so now we are being approached by, funds that do want to invest in us, like Shredder was mentioning. And the thing that we're tripping over is, okay, how do we standardize this so that we can, scale? And so if a deal comes across our table that we can actually give investors that opportunity. So I was actually just leaning over to him. I was like, how would you answer who's the fund manager, who's the money raiser, and who's the expert investor? And I think, honestly, in a lot of ways, we're trying to answer this question right now, so it's an easier story for us to tell as we go, fundraise for this.
So a couple of questions here on, let's stick with this for, and we'll kind of hit both these, I think, for a second. So building a second tier of management, right? How do you incentivize? And anybody can go hire people. I've done the same thing. You can hire. How do you actually really get a quarterback that's like incentivized, that's going to go like crush it, and not go start a competing business, too? Because in some businesses, like, well, screw you, I'm just going to go start a competitor, right? How do you give them enough economics that they're going to stay with you, but not too much where they're taking the whole business, right? And how do you properly incentivize? Anybody want to answer this question? Anybody got any ideas? that have done this before? It's a hard question. That's why I'm like, I don't want to answer it. Just kidding. I know, but I know there's some experienced operators in here that have done this. I always look to incentives, right? Incentives drive behavior very directly. Incentives drive what people do. Oftentimes in my business, we have about 60 employees. When there's an employee like moving around doing stuff, I always look and I always go back like, what's the incentive? And I'm like, crap, it's my fault. I've given them a interesting incentive. They're incentivized in a certain way that'll probably encourages, maybe it's not that they probably should stay with what they're doing, but might give opportunity for this other behavior that I don't like, right? And we've had some operators that crush it. We've seen a lot of success with, you guys have given up equity, you said. We found a lot of success because it's hard to give up equity. It's so permanent. Like, well, what if they're not good? What if they just don't work 6 months from now? We found a lot of success in doing what we call rev shares. Anybody done these before? So a revenue sharing agreement. It's or phantom equity is what people call it. And then later on it can convert to equity. But for example, let's say we're looking to do a new deal together, a new side business. Great, let's do this. We're taking a lot of risk on you as the operator. I want to see that you can prove yourself. So what we're going to do, we'll do a rev share. We'll give you, whatever the number is. Let's do it 60-40. 60% is going to stay with the management company, like the parent company, and 40% is going to go to the new person in the form of rev share. So 40% of the revenue after fees, or let's call it net distributable income, will go to you as the person. It's just like equity. But if you quit, if you leave, if you don't show up to work, this can get taken away. Furthermore, though, if you stay and do well, if you're here for 2 years, this will convert to full out equity. Or if we sell the entity at any time, that converts to equity on a sale. So it acts if you're with us, it acts just like equity. If you sell, you get the upside, you get everything. But if you quit, it just goes back to the parent company. That's helped us a lot. With Fund Launch, we've done this with a number of our people that have been high level people. We've had a few people quit or move on, and their equity came right back. Their phantom share came right back to us. Very useful. Yeah, go ahead. It's also good for them. Yeah, they have lesser liability. They're like, well, I'm not. Yeah, it's an interesting question. Do they get the tax depreciation of the asset underneath it if they're not on it? Probably not. I don't know, actually. Anybody answer that question? Anybody know? Yeah. Just put it in the contract that they get part of that depreciation. Yeah. Yep. Mm-hmm. Yep. 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 So that would be one way to do it. Thank you for the answer. I'll share one other example. I think, and my dad is here. My dad, I told some stories about, is here. Mr. John Payton. Stand up, John. Clap it up for John, everybody. He made it. We can give John the mic here in a second. I think you shared this with me. Within a fund, everyone wants, especially with your capital raisers. This is a great thing to do with capital raisers. Everyone believes they can go raise you a ton of money. Like this person. Oh, dude, I could raise you 15 million, like no problem. Okay, great. Or I can pay you 100 million. So what we've done a few times in our firm, we've done something like this. We've said, hey, okay, great. We're trying to raise 50 million. We're going to give you 25% equity to this person right here. Okay. Contingent on them raising this 50 million. And we're going to set timestamps. And this is going to work like a reverse vesting schedule. If you raise the 50 million, great, you get 25%. However, if you raise 25 million over the next year, your equity is going to work pro rata backwards. You're going to get cut in half. So you go to 12.5%. Does that make sense? If you raise $0, zero, you just don't do anything. We can cut you all the way down to like 1%, something like that. That'd be a reverse equity. And actually, that's been very useful in the capital raising space because it's like, hey, just earn your spot. And you got 12 months and 18 months and 24 months. Yeah, you had a hand, and then we'll go here. Yep. So that's how you get around the owners. That's why you do that. You get the owner's exemption there. So they're an owner on the fund. They really are a 25% owner on the fund. So they get the owner's exemption, which doesn't allow them for licenses. They don't have to have a license to, in some situations, they can raise without a license. Yeah. They're a partner. They're with you. They're a full functioning partner with you. Yeah. Their main responsibility is to raise capital. They also have other responsibilities. They're on your team. They're going to help with all facets. You're a startup business. So they're a partner with you. Their main role is to raise capital. And if they don't raise capital, they get cut back over time. I believe so. Yeah, I believe so. Yeah. So yeah, you give sorry. We're talking about the owner's exemption. This allows someone, if they're like, I'm allowed to pitch my fund and sell a security because I'm an owner of my fund. In some states or some situations without a license because I have what's called the owner's exemption. However, if I hired you to go sell my fund for me and sell a security for me on my behalf, and I'm going to pay you a fee or a commission for doing so, you have to have a license to do that. And so that'd be the difference. You had a question back here? Yeah. Same thing? Okay, cool. Answer that. All right. Feeling okay? Those are a few examples of stuff you could try back to incentivizing people in the right way. We've seen rev share has been very useful. Underwriting that person is hard. Like we said, the holy grail question. Yeah, Dad, go ahead. You want to grab this mic real quick? We got people on Zoom here so they can listen in.
So on the clawback on that, on the 25%, what we found years ago, and I taught brothers years ago, is if you give that person the 25% day one, they go home and tell their spouse, hey, guess what? I'm a 25% owner. I'm an equity owner, right? And they walk and talk the first day as an equity owner. Most people would say, well, when you raise $1 million, we'll give you 0.5%. Then when you raise $2 million, we'll give you 2. They would step into it. And that situation, when you put it like that, it doesn't, the person doesn't go home and tell the person, their wife or their spouse, hey, I'm a 1% owner. But they do when they're a 25 or a 5% owner. And so the next day they walk and talk and act like they are, which they are, 5% owner. So there's a claw back. They get clawed back. So what I'm trying to say is you want the person, the psychology, the next day they're out like, I'm an owner, dude. You should invest in this fund. And that's the ownership thing. And the thing about it is they will never, these are salesmen. These are marketing dudes, ladies. They will never tell their spouse there's a clawback. Because in their mind, it's irrelevant. Of course they're going to raise the $50 million. So why would I tell my wife there's a clawback? I am a 25% owner or 5, whatever it is. I am day one. And so that's why it's worked. Now, I have used the clawback with friends who are getting married in a prenuptial agreement. Okay, it's the same type of thing. Where the woman doesn't want to leave her job. He's retired. This guy's retired. He wants to travel the world. He wants to marry the woman who's in her 50s. She's in a great C-level position. But if she's not ready to retire, but if she quits and goes and gets married and gets divorced in 2 years, she can't get her big C job back. So it's a big risk to her. So she won't sign a prenup. This is actual couple stories. And I told my partner, I said, listen, guys I knew, listen, do a clawback. Say, if we get married, then, if we get divorced the first year, I owe you $100,000. Second year, I owe you $200,000, $300,000, up to 10 years. And after 10 years, there's no prenuptial agreement. It's a clawback, right? Kind of a situation of a clawback. So you walk and talk. So both of them got married, right? And one had a divorce 2 years, and the other one has been married, for a long period of time. But they were not going to get married because neither one of the wives, and they were older women, great career women, couldn't sign a prenup because the risk was too big. And some of the guys that are raising capital for you, most salesmen are hired guns. Most people treat salesmen as hired guns. I'm going to hire you, you're going to do some work, and I'm going to let you go. I'm going to hire you, and they just kind of bop around to companies selling, right? If you find a great salesman, a great marketer, you want to keep that person, you want them in your fund 1, fund 2, fund 3. But you don't know if they're good, like you said. You give them the percentage, then you claw. If they don't do good, then you claw them back, and then you try the next fund, claw them back again, then they got to go. But if they succeed, then you found a gem, and you've changed the psychology of a salesperson to, I am an owner now, not just some hired gun. So that's the
Well done. Clap it up for John Pennington, everybody. Well done. Well done. Hopefully that's somewhat useful on partners. Okay, we'll move through some of these as well. Let's touch on. Well, actually, Dad, we got you here for a minute. This is a good question. I think that you can. I was gonna share your answer, but you can answer. This is the question around. Joe asked this: small investors versus big investors. Do you want to explain your question again, Joe, and then?
Struggling with, we've got a big fund right now that's coming in at 270 million, and struggling with pitching the needed GP. So we got an investment into our GP, and that's a $10 million ask that we're looking for. And when the big money's coming, and we just got 35 million on another fund, they're looking at us like, you don't need us. Why do you need us on this small stuff? But that's what we're needing to raise right now for our operational capital.
To summarize, the mix of, and so you're raising 10 million for the GP, to like be it to buy into the actual GP. Okay, so you're raising, if I drew it out like this, you've got, this is your GP, you're raising 10 million. And it's a percent per million. Okay, and then you've got your limited partnership, you've got about 250 million committed to this thing. 270? 270, sorry, I keep saying 250. 270 coming in from one check writer, right? Furthermore, are you trying to raise small people here on this? Or is that going to capitalize the whole? It'll be a single investor fund. So you're now wondering, on the 10 million.
When we have that big money coming in, they look at all of our agreements and things that we've accomplished thus far, and they're going, you don't need
Who? Yeah, who's they? Explain they. Yep. This group, this 10 million here, they're like, so you're pitching me right now, and I'm like, why do you need my 10 million? You got 270 coming in. So answering that question. Cool. Well, and answer the question, why do you need the 10 million actually?
Because we need operational capital, we need to hire a couple engineers.
You need 10 million to do that though?
Well, so part of our problem is when we do the lockup locations too. So we just locked down Ohio, that cost us 2.5 million, and we're building out a $2.2 billion power plant. So the expense is massive.
But why are you doing it out of the GP? Why wouldn't you just do that out of the LP? Why wouldn't the LP be the one who buys the land? But why don't you raise 10 million in the LP? And then that can get the LP going and get this started, and then the 270 can come in later, and you could be partners in that fund.
We like having the funds in-house, so we can use them however we want
To be in the GP. So now they're partners with you in the GP. Okay, interesting. What do these guys think? The 270. They'd rather have you guys do all the upfront work, and they're like the last check-in that like capitalizes it. Interesting. Okay.
Is the fund going to reimburse once this is up and running? This is spent, and you buy some assets. Are you going to put that in the fund and have the fund reimburse you?
So one nice thing about the fund is we do have a 2% management fee. So on the 270, we'll get our first 70 million in a month. We do get the 2% management fee of that full 270 million. So that helps us too. That goes back into the actual business.
Yeah, but you get that yearly, 2% on a quarterly basis. You get a half a percent every quarter.
No, we're doing the full 2% right off the gate.
Yeah, I wouldn't do that. I mean, it's good for you. I mean, they were fine with it. Okay, well, I guess you can take it. But most funds take a 0.5% per quarter. There's been a few funds around here that have taken like 5% up front. They take their, that's what they do. That's what most funds do. There's been a few funds around here that have done, hey, it's 2% management fee over 5 years. And so we're just going to call it 2 times 5 is 10. We're going to charge 10 up front. I'm not going to say any names. No names because we're streaming here. That's what they've done. And a lot of people signed up for that, and they didn't realize what they were signing up for. They're like, it's a 2% management fee. I'm like, well, no, it's 10% day one. So you invest 100,000, you really only invested 90,000 day one. Oh, she's doing the whole. So anyways, most funds are 0.5% standard. Is just help you grow. If I was to read, now you've obviously thought through this a lot. Bringing people into the GP seems interesting. What are your thoughts on that? I would almost bring them into the LP or set up a parallel LP like another LP here, because you want them to be limited partners. It's way better if they're limited partners when you're raising capital from them. They have an LPA PPM. It's better for them too, I think. Because at 10 million, you're going to have how many people are going to come in on that? So you have a possibility of taking 100 investors here. It's a lot of people in your GP. I would do it in your LP. I would set up even a parallel LP. And this could be phase one. You raise 10 million here, and this gets the land ready and does all the permits and stuff.
We could pivot still at this point, right? We've raised
Can you guys see this okay? Sorry, I keep standing in front of it.
we've raised almost 5 million up to 10, so we could still pivot moving forward and do the LP.
What do you,
Yeah, you go. Sure, you can always go back to them because you haven't really gone into operation. You can go back. You can have this fund reimbursed. This is called a parallel structure. Okay, this could be a 3C7, one investor, right? And this could be a 3C1. So you have 99 investors here and one investor here. These two funds invest pro rata into all of your assets. And when the GP, a lot of times GPs start their funds, they go out and buy assets. And then when the fund actually launches their first closing, the GP will take their assets they purchased, put into the fund, okay, and take a piece of the LP position. And now the funds own the assets, not just the GP.
look behind you here
Yeah.
on that screen. That's exactly what you're explaining.
Yeah, there you go. There you go. Yeah, parallel. But the key here is if you don't do that, the GP isn't correctly aligned with all the LPs. And so you have to correctly align the GP's interests with the LPs. So there's less conflict of interest, right? So let's say the GP held on to let's say a big huge copper mine. And the GP took the middle square of the copper mine where the mill is, and then let the LPs own all the land around it, right? And then the copper mine goes bankrupt, right? Well, the GPs are going to keep that, and they're going to try to sell the middle piece because there's a conflict of interest, right? But if you can't eliminate conflict of interest, you can just diminish it as much as possible. And that's what I think Bridger's saying here, and that's what I'm saying too.
Can you share one more? I think it's the original question I thought you were asking, and you've shared this before. When you've brought in big investors as well, you've had to have the little investors still. Even when you guys have raised like $1 billion fund, you have to bring in little investors, and explain why.
Yeah. So you're going to raise $1 billion fund. So you're offering here's $1 billion, and we do a parallel structure. One's a 3C1 and one's a 3C7. And so what happens is institutions, they take 5 to 7 months to do due diligence. But you need to go now. You can't wait 5-7 months, right? And you got 5 or 7 big institutions, and they don't fly out to see you unless they can give you $30 million. And when they give you $30 million, they don't want to be more than 30% of your fund. So you got to have a closing of $100 million just to have that one come in. Okay, so that's number one. And number two is we always kept all the small investors, and so what happens is in the first 3 to 4 months, all the small investors come in, and we get to 75 million. And then in month 5, all the institutions start calling back, hey, how's it going? How's it going? And we say, yeah, we were already 75, 80 million dollars. And they're going, oh crap, we need to hurry up and get in because you're going to be oversubscribed. And so if you raise $1 billion, 85 million is high net worth individuals, but they're the catalyst. You understand what a catalyst is, right? A catalyst isn't the engine. A catalyst gets the engine going. And then the engine takes off and does all the hard work, but the engine can't move without the catalyst. The catalyst seems to me is all your little investors come, and we tell them, listen, if you wait to the 4th closing 6 months from now, you're not getting in. Because when we have a dude that's going to give us a 30 million, 80 million, 170 million dollars, we're going to oversubscribe. You're not getting in. So you better get high net worth. You better get in the first 3 or 4 months, because if you wait to month 4 and that gets them going, yeah, I got to get, and they get there, you get 75, 80 million. And then, all these guys come in, and then you hit $1 billion. That's how we've used it as a catalyst. And right in between there are family offices. You have the high net worth, you have family offices, you have institutions. Institutions take a long time to do due diligence, a long time. But once they do, that's great. If they call you back in 5 months and you've raised 0, they go, well, we're still looking at it. I'm going to give a few more weeks, we'll call you. But they call back and you have 85 million, they're going to hurry up, and in 1 more month, they're going to start writing you checks.
that helpful at all? It always, yeah, first check's the hardest check. It always is. No one wants to be the first check. Everyone wants to be the last check in, right? Yeah, well put. Thank you very much. Okay. Do you still want to hit these? What do you guys think? How are you guys feeling? Still hit a few? Let's do this. We've been sitting for a while. I'm good to stay for, I know we're coming up on noon here in a second. I'm good to stay for a few minutes and answer questions. Then we went a little bit long on some of these. I don't know if y'all want to stay. We can do whatever. Let's do this though. Stand up for me. Just stretch out. High five two people. Say hello. There's bathrooms back here. There's drinks. There's shirts. Talk to people for a second. We'll do like a 2-minute, 3-minute break here, and then we'll keep going. Sound good? All right, y'all. You guys are welcome to grab merch. If you have it, it's all free. Just take some if you want. If anybody wants, I can stay on the whiteboard for a few more minutes, and we can just whiteboard questions out if we miss stuff, or just network and hang out. So I'll be up here. Just come find me.